with higher rates until you're maybe below 3% into the twos.
I'm curious about one dimension of this speech. He talked about the need for below-trend growth and easing of the labour market. We don't have below-trend growth. When they talk about being sufficiently restrictive and telling us that they think they are, what evidence do they have for that, Mike?
Well, they don't have it yet, and Powell noted that. He said it looks like growth is faster than anticipated, and certainly the numbers, the preliminary numbers for the third quarter are telling us that. And I think that feeds back into his assertion that we are not done and we will do what's necessary, because he made a tie between the idea that the economy is moving at a faster pace and the labor market and the fact that we could see inflation develop out of that, which is something that some of the other more hawkish members of the committee have suggested, that the growth rate is something that concerns them. So he tied those two together and leaves the possibility of higher rates maybe even a little bit closer than they were yesterday.
Mike, stay close. You going to stick around?
Yeah.
Patrick Harker coming up a little bit later. The first reaction from inside the Federal Reserve, right here in Jackson Hole, Wyoming. That interview coming up in about 30 minutes from now. The perfect guest for reaction to this speech is Mohammed Al-Aaron of Bloomberg Opinion and Queen's College, Cambridge. Mohammed, thanks for being with us and being with us through that speech as well. What were your thoughts when you heard some of those words from Chairman Powell just moments ago?
I had three takeaways, John. First, it's a speech that said very little that is new. He repeated what he has said in the past, and he has retained maximum policy optionality. Second, he reminded us that with the exception of the inflation target, which he said is 2% and will remain 2%, everything else is uncertain. And his reference to our star in particular was very interesting. And third, what I thought was also curious is how he ended the speech. He ended the speech talking about, we will follow the stars in a cloudy sky. Everybody sees the cloudy sky, but what's interesting is that the rest of Jackson Hole will be about moving stars, all the structural changes that are going on domestically and internationally. And that just adds to the topic that the three of you have been talking, that it's a very complex world out there, and the Fed has to navigate a lot of moving pieces.
Mohammed, one conversation you and I have had over the last several weeks, the last several months for that matter, people are having this discussion here as well. Are we, from your standpoint, in your opinion, sufficiently restrictive?
John, this goes immediately to what is the right inflation target. If the right inflation target is 2% and they want to get there in a credible period of time, then we are not sufficiently restrictive. If the right inflation target, as you've heard many people say, including Adam Posen today, is above 2%, given all the structural changes, and the way we're going to get there is not by announcing the new target, but by following a shadow target, and then once we see it stable, adopting it, I think that's the most likely outcome, by the way, then we are sufficiently restrictive.
Mohammed, does it concern you that we've heard a lot of people who sound pretty happy, actually, other than Jay Powell, who is taking sort of the adult tone of, we're not there yet, stop declaring victory, there's a lot more down the pike. Everybody else sounds like things are going really well, and the Fed policy is achieving exactly what it sought to.
So I don't think it's everybody else, but most people are, especially in the marketplace. Not so the economists. You have Larry Summers, for example, reminding us this morning that if you look at the 70s inflation cycle, this one looks very similar. He has the two graphs up, and he's sort of warning implicitly that we may see a pickup in inflation. So I think the marketplace is much more complacent than the economists are. The economists recognize that there are many moving pieces, whereas the marketplace thinks that we've gotten to a new equilibrium, and from here is going to be cuts next year. That remains to be seen.
Do you think, Mohammed, that it's important for the Fed to get ahead of a potential resurgence in inflation, or do you think that Jay Powell's approach of watching the stars and seeing what they are will be sufficient to curtail some sort of more embedded inflation?
It's hard, Lisa, because as you know, they have not, like past Feds, opted for a strategic view of inflation, nor do they have a functional monetary policy framework. So they've become highly data dependent, which means that they are using instruments with lags on backward-looking data. So they are in a bit of a tough situation. They're going to remain data dependent. So I don't think he knows what they will do in September. He's going to wait to see what the jobs report is. He's going to wait for the CPI numbers, and then they're going to decide what to do. But this is the irony: it's a highly dependent, data-dependent Fed using instruments that act with a lag.
On radio and television here from Jackson Hole, Mohammed El-Arian with us this morning. And as Dr. El-Arian speaks, John, markets are moving here. I just noticed the rebound in dollar back above DXY at 104 to Global Wall Street. That's important.
Break of 108 on the euro as well, Tom, against the dollar right now, about 107.95. Equities elevated through that speech, but coming back just in the last 10 or 20 minutes. Yeah. Plenty of feedback, Tom. This coming from Neil Dutta of Renmac, just published in.
Please.
Saying the following: I thought Powell delivered a neutral speech. The Fed sees its monetary policy stance as restrictive and will make a more tempered approach to future meetings. Proceed carefully, risk management. These are all catchphrases for do nothing right now. The view from Neil Dutta just moments ago.
A lot more response coming in here. Mixed market, red and green on the screen. Dr. El-Arian, I want to touch upon your iconic work in game theory. And that the word that I'm hearing this morning is complexity. I heard it from you. I heard it from John Lipsky and others. The simplicity we're all begging for is T decisions. You are known for this. This is a Jackson Hole devoid of T decisions. How do our viewers and listeners handle the complexity now and to come?
Tom, I think the most important thing to understand is that we have left the world of insufficient demand and we are now in a world of insufficient supply. And there's many reasons for that. It's a world that's not going to go away anytime soon. It's not pandemic issues that are fully reversible quickly. There are longer-term issues going on. Changed globalization, supply chain management, the functioning of the labor market, and the list goes on. So we are now in a different world of supply-side constraints. And that world will mean that countries will become more inwardly looking, which we've seen already. And it also means that policy has to adjust to that. Now, put on top of that the layer of industrial policy as we embark more meaningfully on a green transition. And it's all about the supply side, Tom. And that's where monetary policy is really challenged, because it acts on the demand side.
We're thrilled, Mohammed, to have Dr. Georgieva with us, and then you and Christine Lagarde with us later. And the heart of the matter is, are we beyond the supply shocks of this pandemic? Where are we on that continuum, Mohammed? Have we escaped COVID?
I mean, we've escaped the worst of COVID, but we're dealing with the legacy of COVID. But we're also dealing with the legacy of the war. We're also dealing with many other legacies. You know, Tom, it's fascinating that you will have President Lagarde on, because if you think the U.S. is complicated, then in terms of degrees of complexity, Europe is even higher. The UK is even higher than that. So it's going to be really interesting to talk, as you will do, to President Lagarde, because even though she has a single mandate, her environment is significantly more complicated than the Fed's, which is already complicated.
So, Mohammed, she is so much more exposed. Europe is much more exposed to what's developing in China at the moment. Mohammed, if you took the US out of the equation right now, and we were talking just about Europe and China, wouldn't we be talking about things like rate cuts and easing and stimulating the economy?
If you take the U.S. out of the equation, you would be talking about stagflation. And that's what everybody is afraid of. The U.S. is exceptional, and it's exceptional in its economic performance. And if you take the U.S. away, then you're taking away the only engine of growth for this global economy, but you're not taking away the supply side issues that are causing the inflationary pressures. So if you take the U.S. away, we would be talking about not just the risk of stagflation in Europe, but you would be talking about the risk of stagflation in the global economy.
Mohammed, is that the risk or the reality in Europe right now?
John, is still the risk. Yes, Germany is struggling the most, and that is, if you like, the engine for Europe. But there's also good things happening in Europe away from Germany. It's a high risk. It's flashing red, not even yellow. It's flashing red, but it's not yet a done deal. The US is much better off. China, ironically, is the one that's suffering the most. As you've been discussing all morning, there is no obvious policy response, and now these piecemeal responses are being rejected by the marketplace really quickly. The marketplace is no longer embracing the notion that China can get itself out of the mess it finds itself in.
And that's perhaps the cause of the manufacturing recession that we see in Germany and parts of Europe. But the services side, we've been talking about how that's maybe more directly affected by the ECB's policies and where rates are and the more direct transmission mechanism than in the U.S. Jay Powell just said that there is evidence that the long and variable lags are coming to the fore and will actually reduce growth materially in the U.S. Is Europe a model for where the U.S. is headed with respect to services in the next couple of months or in the next year?
I hope not, Lisa. Our service sector has been stronger, and even though the PMI numbers this week were disappointing, at least they were over 50 for the service sector. We don't want PMIs south of 50. And also, ironically, the service sector is where Europe gets the stagflation as well. It's not the goods sector, it's the service sector that's the inflation source of an inflation problem. So I hope we don't follow Europe, because if we do, then we will be talking about a very different outlook for the U.S.
We're still talking about the potential for some sort of weakness down the pike. One thing that Jay Powell's speech did was seem to remove rate cuts in the near future, at least for the foreseeable future, and you can see that shifting upward in the rate expectations. Do you think that this economy can handle a 5% Fed funds rate for the remainder of next year, even with all the strength that you're hearing about?
Lisa, we don't know, and he did use the word agile, and that's absolutely correct. He's got to be agile. Look, there are all sorts of sectors that adjust with a lag. We haven't seen the full impact yet of the higher rates. You're starting to see it play out in various segments, but in a very small way. Remember, not everything gets refinanced immediately. This is very unlike the UK economy, where the effective duration is much shorter. So you get refinancing quickly, and the rate effects happen much quicker. So we don't know how well we can navigate the 5%. It seems that the big issues in the banking sector are behind us. But so far, and it's really important to stress this, we've dealt only with interest rate risk. We have not dealt with credit risk. We have not dealt with liquidity risk. And that's what people in the marketplace have to keep an eye on.
Mohammed, stay close. Just want to go through what we've heard in the last 30 minutes from Chairman Powell. The 2% inflation target is and will remain our inflation target. We'll keep at it until the job is done. A far more nuanced speech from the Fed chairman this time around compared to, say, 12 months ago. Plenty of feedback on the Bloomberg terminal. Thank you for that. Keep it coming. This from one subscriber this morning saying, back in 2022, this was the quote, "We're taking forceful and rapid steps." 2023, the quote this time around, "We're in a position to proceed carefully." It's a very, very different tone, to borrow Lisa's language, in the last few moments compared to, say, a year ago. So let's take a look at the price action from where we've been from this morning through that speech and out the other side. Your equity market's shaping up as follows on the S&P 500. Equities right now just about unchanged. Equities going absolutely nowhere. In the bond market, yields up, Lisa, by 3 basis points to 426.90.
And that's on the 10-year. On the 2-year, you're looking at a new high of 5.08%, which is interesting and speaks to this potential for another rate rise, but even more, no rate cuts in the foreseeable future, and that's something that's new.
Stuart Kaiser of Citi, publishing just moments ago, give you a flavour of what's happening on the south side. Not a game changer for markets from Chair Powell, but reminders on upside risk to inflation that demand downside risks to growth. Mohammed Al-Erian still with us. Mohammed, I just want to finish on that with you. The downside risk to growth to counter the upside risk to inflation. Is that something we all need to be cautious of going into year end and beyond?
Yes, and that's why Chair Powell had a speech full of optionality. You know, I go back to what Mike McKee correctly said. It's not that the content was new. It wasn't. There was nothing in that speech that we didn't know before, whether it was explaining what has been behind inflation or whether it was explaining the range of policy possibilities and the risks and the need for risk management. All that has been said before. What was notable this time is that it was packaged slightly more hawkish than dovish. And that's what people are picking up on. But ultimately, John, if we step back, the only thing he said is that what we know for sure is his belief is that 2% is the right inflation target and will remain the right inflation target. That issue is going to be hotly discussed in the next quarters as we get more and more data.
Yeah, Mohammed, I don't think that debate's going away anytime soon, even if Chairman Powell tries to put it to bed. Mohammed, thanks for being with us today. Appreciate it, as always. Mohammed Al-Arian. Let's go through the markets. Equities on one board, bonds on the next. We'll finish on foreign exchange. Starting with stocks. In the last hour or so, the price action shaping up as follows on the S&P 500. And on the NASDAQ, we look a little something like this. Equities on the S&P just about unchanged now, going nowhere, so we fade from where we were at the opening bell. On the NASDAQ, just about unchanged as well. If you switch on the board and get to the bond market, we'll just slice up this yield curve. 2-year, 10-year, 30-year. Cycle high on a 10-year in the last week of 436. Yields were lower initially, now they're higher by 3 basis points on a 10-year, 426.70. That 2-year really close to a cycle high right now of 5.08% and higher, Tom, by 5 basis points on the day.
To cut to the chase, if I'm a CFO of any large cap, mid cap company, I'm looking at that data check and I'm going, how do we adjust to this? Critically off the real rate, which is not through 2%. But I'm sorry, these yields are something where everyone has to adjust.
That 2-year, not necessarily higher, but high for longer. That's what we're starting to think about.
Yeah,
just
the longer, I agree. The longer.
High for longer. I want to finish on foreign exchange. Yeah. Off the back of that, the euro, a break of 108 again. The euro against the dollar looks something like this: 107.84. We're negative 0.2%. If you want to take a look at cable, the pound against the US dollar, 125.74 here, Tom, negative 0.2%.
We're going to continue this discussion and really stay with you for the next number of hours. Moving to Christine Lagarde here, after her speech here, I should say, at Jackson Hole. Please look for that. But far more, it will be analysis and interpretation. Owning the high ground on that is Joseph Weisenthal and Tracy Alloway. They host a podcast, Odd Lots. Alloway had to redo her fireplace mantle because the awards have come in.
Oh, right.
So
they're
large. Yeah, they're piling up. I mean, Weisenthal already had a mantle that could hold 300 pounds.
In New York City.
Joining us, Tracy Alloway from Outlets. Weisenthal would not get out of bed this early this morning. What I love about your work back at the FT and years ago is you own a perspective of London and New York in synthesizing the Western world. China and an exceptional Japan with Ueda in attendance here in this YCC disaster, just had to listen to his hawkish one. How does Asia interpret what we heard this morning?
Well, I'm kind of confused at some of the bond market action that we've seen. So 2-year yields going above 5%. Hawkish interpretation, but I'm on the Neil Dutta side here, which is this was a very dovish speech, actually. Powell sort of gave a nod to the R-star debate, the idea about whether or not the neutral rate of interest is structurally higher in the current world. But then in the next sentence, he basically goes, but we have no idea what R-star is anyway, so it's completely irrelevant. And they're talking about being at restrictive.
That's not a small matter,
already.
John. Yeah, that's not a small matter. This has come up a couple times today. The guy from New York City, you know, the private equity guy, whatever Powell is, he's not too big on the plugins of R-star.
But Tracy, something you've discussed, this probably shouldn't come as a surprise, should it?
I don't think so. To me, it very much resembles what we saw last month from Powell. It's very much a data-dependent speech, which makes sense because you have 2 major data points coming up before the next Fed decision. Why would Powell stick his neck out at this particular moment in time? And of course, there is a lot of uncertainty about those long and variable lags, as you were talking about, Lisa.
Well, and this is a problem right now for Jay Powell because he wants to bring things down, but he doesn't want to curtail dynamism too much. Do you think that it seems fair to view his speech as saying that rate cuts are not in the cards for a longer period of time next year? Because that's maybe what he wanted to say. in the implicit sort of tone, but not what he actually said.
I think he'd have to see a real deterioration in the underlying data to justify a rate cut, and that's just not happening. We have a lot of sort of anecdotal data points about maybe consumer spending is starting to weaken, but we haven't seen any of that in the unemployment rate, right? Now, that said, I know the tone of this particular Jackson Hole is very different to last year, where Powell was talking about how we'd have to assume more pain in order to bring down inflation. But that said, it's still a really uncomfortable moment for central bankers because inflation is coming down in a way that they didn't necessarily expect, right? The Phillips curve says that if inflation's coming down, the unemployment rate should be going up, but that hasn't been what's happening. So there's still a ton of uncertainty here.
This is essentially, while it is global central bankers coming together, it's also essentially an academic conference. You're here with Odd Lots to speak to some of the academic research. What are you hoping to illuminate in this whole shifting global structure that was sort of the theme?
Yeah, that's exactly right. So I know that the focus is always going to be on the sort of short-term outlook for interest rates, but really Jackson Hole is about the long-term framework of monetary policy. And one of the big themes that is starting to emerge is this idea of higher public debt. And we've seen that borne out in the Fitch rating cut recently, bond yields higher because of some concerns over the outlook for U.S. fiscal health. And again, the unusual thing about this moment in time is that we are seeing massive fiscal spending at a time of low unemployment. That hasn't really happened before. And so I think there are a lot of people at this conference who are wrestling with that idea and that dynamic.
You and Joe Weisenthal have Rockstar Hours. You just sort of wander in and you do your podcast, and you do it by piecing together conversations where Bloomberg surveillance is complete and total chaos 24/7. What's the conversation here you're most looking for into your next podcast?
Well, thank you for assuming that All Thoughts isn't constant chaos as well, Tom. Well, we're having you on later today.
No, that doesn't count. That
No,
was
it
just,
counts.
Oh, please. What's the conversation you want right now at Jackson Hole?
Okay, the big picture goes back to that bond outlook. What does a world of structurally higher debt look like? Does it necessitate higher interest rates? And what new financial risks does it introduce into the system? So we basically moved from a system that was very much reliant on bank lending to one that is far more bond-based. And how do you square a world where bonds really, really matter with central bank mandates to bring down inflation? There's a tension there. You can't build the financial system on bonds and assume that they're going to be very low volatility and then try to bring down inflation and have higher rates.
Tracy, this was great. It's good to have you here.
Thank you. Thank you for having me.
Thank you very much. Tracy Alloway, the co-host of the Odd Lots podcast. Let's turn to the price action. I want to bring your attention to the 2-year. If the 2-year closed right here, right now, on a closing basis, that would be a new cycle high, 5.09%. Yields are higher at the front end by close to 7 basis points, just short of 5.1%. I believe the cycle high intraday was something like 5.11% earlier on this summer, but we're getting closer off the back of this speech. Not the initial reaction, but it's the reaction in the last 20 minutes or so. The 10-year yield's higher by 4 basis points, 4.28. The cycle high there was a little bit earlier in the past week of about 4.36. Right now, 4.27.89. Just to go back to what Neil Dutta said, described it as neutral, Bramo. Said it was a neutral speech from the chairman. I said, don't define that speech by the intraday price action off the back of it. I don't think you should do that now either. But ultimately, the early interpretation of what we heard from Chairman Powell in the past hour is high, potentially for a whole lot longer.
And this concept of we are getting back to 2%, the fact that he led and emphasized with that really highlights that he's trying to cast cold water on all those people saying, maybe we just need to fudge a little bit, then everything can be good.
There's 2 events today. Chairman Powell, that event's behind us. The other one is to hear from ECB President Christine Lagarde. So let's put those two together in one currency pair, the euro against the dollar. And clearly the dollar is where the strength is right now against the euro, which is weaker. The euro against the dollar at the moment on my screen, 107.76. Tom, that's your break of 108 all over again in the past hour.
You see that with the euro, and then you look at sterling. Remind me where Jordan Rochester was at Nomura. What's he?
Jordan's talking up. He's talking up 122 on sterling, and he's talking up or talking down euro dollar to about 105.
And this is where Jerome Powell becomes central banker to the world. We're not talking about Bailey, central banker to the world, Ueda, even Lagarde. we're talking about Powell having to react to each and every type that's here.
Mohammed was with us 20 minutes ago, Tom, and he was talking about the risk of stagflation in Europe. My question was, is that a risk or reality right now for the Europeans? And I know you'll have that conversation later with President Lagarde.
It's going to be interesting. And the key word I've learned today, folks, for those of you just joining us worldwide, thrilled with the feedback. Thank you so much for your feedback as we really commit to this debate about where are we heading into 2024, or for that matter, 2034. But really the heart of the matter for me is one single word: complexity, and how it redounds onto others as well. So we will take a turn here and look at the central banker of the world and how he affects other nations. Lesetja Kganyago joins us now, governor of the South African Reserve Bank. You know what I did on the Bloomberg, sir. I went to USD ZAR to capture the thermometer of the Powell speech upon EM as well. What are the ramifications if South African Rand breaks through in the coming weeks to new weakness, dare I say, to a 20 level? What is the ramification of weaker currencies right now?
Well, we are a central bank that targets inflation. And the focus is on what that would, if such a weakness does materialize, what it would mean for inflation in South Africa. We have started much earlier to tackle inflation. It has come down significantly. It is now closer to the midpoint of our inflation target range. And on the horizon, we actually see the exchange rate as one of the risks to the inflation outlook. So if there was to be a weakness in the currency, it does have implication for the inflation outlook. Though what we had seen had been that the pass-through effects from the exchange rate to inflation had weakened over the past while.
So on balance, Governor, is this high for longer? Is that the approach of the South African Central Bank? Is it similar to the Federal Reserve and what we heard from Chairman Powell, or is it different?
Well, we are focused on the outlook for the South African economy for both growth and for inflation. The job is not yet done. The decline in inflation is welcome, but we have just had two good prints of inflation. That does not mean that the inflation monster had been conquered. There are still risks on the horizon, and we would watch that very closely.
So it took you 30 hours, I believe, to get here. Is that correct?
Yes.
It took you 30 hours and transferring through different places to get to this remote spot.
It took us 30 hours to get from New York.
It's such a remote spot. What were you hoping to hear? Was this speech worth it?
It's always important to hear what the chair of the Fed says, because what the Fed does has got implications for global financial conditions. And as a small, open economy, the effects of U.S. monetary policy have got implications for our outlook. Jackson Hole is always a place to learn. It's not just about the speech of the chair of the Fed. Many of you, I know that is what you watch, but there are very important technical discussions that are going to be taking place over the next 2 days.
There's a bias here, Governor, that I think you can help us blow up. The approach is always, what can you learn from them? What can they learn from you? Emerging market central banks, they are the original front loaders in this cycle. You guys got ahead of this before these guys, before the Federal Reserve. What can they learn from the inflation dynamics that we typically associate with emerging markets? What can they learn from you?
Well, as emerging market central banks, we can tell inflation from a distance. We have, unlike the advanced economies which had experienced close to zero inflation, we had always lived with inflation for some time. And I think that the important lesson just for all the central banks is that complacency could become the enemy. And secondly, that the decisions that we have to take are very complex, but that you can't wait until you have got all the data before you act. By that time, it would be too late. So a risk-based approach is the correct posture.
So do you think that on the margins, this Federal Reserve is complacent or too complacent to track the data and to be data dependent in a way that's backward looking and not getting ahead of inflation that can get out in front of them?
Central banking and monetary policy decisions are very complex. And I have got no doubt that the decisions that the Fed takes, they take them on the best information that they have. And this is central banking. And you make decisions, and economic history always judges you. So I will leave it to them.
Something that has happened in the news, which is agreements of China and your South Africa building technology utilities in South Africa brick by brick. Help us understand what South Africa just signed on an economic basis with China.
I have not been privy to those kinds of agreements. What I can tell you is that we, as central banks in the BRIC community, we have been in conversations with each other, and our focus had been really on the business of central banking. It had been a focus on putting in place safety nets, and secondly, making sure that our payment systems are interoperable and that it could facilitate trade. That is what central banks have been focused on.
Governor, I've known you a long time. You've been a good friend over the years. Thanks for being with us. Appreciate it. It's good to see you here in Jackson Hole. Thank you, sir.
Much appreciated.
Governor Lesetja Kganyaga there of the South African Central Bank. A couple of headlines I want to draw your attention to. Might be a wrinkle in the outlook for this Federal Reserve, by the way, as well. This from the auto workers, authorizing the union to strike if contract talks fail. UAW members clearing the path for an auto worker strike as soon as September 15th, so potentially the middle of September. We talked about this a lot over the last couple of weeks. We had a deal with UPS. Higher wages. We've had a deal with the pilots over at American Airlines, higher wages. And Lisa, one thing you said we haven't had are the strikes that go with some of this labour power. You wonder if that changes over the next couple of weeks.
And what they have to get if it doesn't change, right? In other words, what kind of concessions do they get from the auto manufacturers that they've said what will amount to about $1 billion in extra costs every year?
These are market moves in the last 10 minutes, and I'm going to suggest, folks, may be wrong in this, we're a bit abandoned out here, but this recent move, John, is off this auto worker news. Equities, soggy, yields moving up. We're starting to talk about 2008 levels, dollar dynamics as well. There's more going on than just Jackson Hole.
Does this complicate the effort of this Fed chair, of this Federal Reserve?
Yes, because there's something in the air. Far more important about this is that John may be leaving. I don't know if you know this, folks. John may be leaving us here in the coming weeks for UPS trading to try to get towards.
Hey, jokes aside.
Can you see him in the brown shorts?
He's going to work for UPS during the day.
I said American Airlines on the weekend.
American Airlines on the weekend.
American Airlines is my airline. I was
Okay,
going to
there
do
you
that on
go.
the weekend.
You'll get status.
Think what
Finally.
Sean in Boston has done with Teamsters and bring that over to UAW.
Yeah.
This is not your mother's UAW. This is not Steve Radner's UAW. It's got to be a new UAW.
And then I'm going over to the governor, to Joburg. I'm going to be an intern at the South African Central Bank.
Good.
Next summer.
You're still going to have to
Next
get your
summer.
luggage.
I don't think Lesetja wants that to happen at all. It's just like, absolutely no thank you. No thank you. Coming up shortly, the Philadelphia Fed President Patrick Harker, the first reaction from inside the Federal Reserve to that speech from Chairman Powell. That's all coming up shortly. Your equity market right now, negative on the S&P 500. In the bond market, yields higher by 6 basis points on a 2-year, on a 10-year here, up by 3 basis points. It's yields up, dollar stronger, stocks down. This is Bloomberg.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's Renewable Assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset? monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
It is the Fed's job to bring inflation down to our 2% goal, and we will do so.
People say you can't raise it now, but my worry is the opposite, which is you say 2 means 2, but it's going to be another 2 years before we get to 2.
They have to have a credible strategy for getting to 2%.
It's way too early to declare victory.
It's a very complex world out there, and the Fed has to navigate a lot of moving pieces.
This is Bloomberg Surveillance, live from Jackson Hole with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
We will keep at it until the job is done. The message from the Federal Reserve Chairman in the last hour, live from Jackson Hole, Wyoming, for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Alongside us now is Bloomberg's Mike McKee. And Mike, I don't think we should waste any time. Joining us is Patrick Harker, the Philadelphia Fed President. Patrick, good morning.
Good morning.
Let's start right here. Not what Chairman Powell said, but what your colleague over at the Boston Fed said in the last 24 hours, that this resilience of this economy suggests maybe we might have to do more. You take a different view. Why?
So look, we have to get inflation down to 2%. We all agree on that. I mean, we're all committed to that. The question is how to get there. We are at a restrictive stance, in my view, and we're putting pressure on the economy to slow inflation. The question is whether we need to increase the pressure or just keep pushing. And I'm in the camp right now, just keep the pressure going, let this work through. Again, the data may dictate that we change course, or I change course. But for right now, what I'm seeing and what I'm hearing, particularly the soft data, what I'm hearing, I've been around my district all summer talking to people, is that the plea I hear is you've done a lot very quickly, right? You've taken a lot of pressure quickly. Now let us work through that. Let the banking system work through it. Let the corporations work through that. So that, I agree with that. I think we just keep the pressure on and see how things turn out.
Jay Powell didn't really say anything new, but he did sort of cast it in a hawkish light. And he talked about how the economy is perhaps growing faster than anticipated, and that could increase inflationary pressures. So what would it take to get you to change your view and think we need to raise rates more?
If we saw that the decreases in inflation were stalling, right, that we weren't making that progress that we need to make.
But what would that, how would that manifest itself? Because the people who calculate CPI, the analysts, suggest we're going to see it go back up just essentially for mechanical reasons.
On the headline side, for sure. But we're going to see shelter inflation come down, right? That it's coming down now. You see this with real-time rents. So if service inflation in particular, or core service inflation, whatever you want to call it, super core, if that continues to stall, then I'd say we have to do more. But again, I really want to emphasize, we are doing something right now. It's not as though keeping rates where they are is doing nothing. We're actually continuing to put pressure on the economy.
You said, and Jay Powell just said, that it was important to get inflation back down to 2%. That was unequivocal.
Correct.
Does it matter when? I mean, we're right now can see in the dots that it's not until after 2025. If it takes till 2030, does it matter?
Oh, yeah. 2030 is a long way off.
2026, 2027, when's this sort of
we're going to get under 4 this year, under 3 next year, and then get to 2 in 2025. So, yeah, it's going to take some time. But what really matters, what I hear all the time is not just the headline, not just super core, but think about the essentials of life, the things that people really need: shelter, food, transportation, energy. As long as they're moving in the right direction, Americans are better off. And we need to be committed to that.
You clearly think we're sufficiently restrictive. Other people think we don't. So let's go through their points. Unemployment is still 3.5%. Growth this quarter could come in at about 3%.
Yep.
What is the evidence that we're sufficiently restrictive? What can you actually point to beyond the soft data? Let's talk about the real hard data.
So inflation is starting to soften. We are hearing story after story. I'm hearing of...
And you think that's connected to where interest rates are right now?
Yeah,
What's the channel for that?
Labor markets are definitely easing up. We're hearing this over and over again. It's easier to get employees. And the retail numbers I'm a little suspicious of, because what we're hearing, for example, from a major supplier to the back-to-school market is sales are not what they expected. So we are starting to see these early signs, but they're early, right? And so I don't think we need to react either way right now. Just let this ride a little bit. Let's just keep putting the pressure on.
Well, if you keep the pressure on, but even don't raise rates, how long do you need to keep the pressure on? When would you see moving away from the peak?
Clearly not until next year at the earliest. And when next year, again, the data will have to dictate that.
Well, there is a question about if inflation keeps coming down, real rates continue to rise and put additional pressure on the economy. Would you see the Fed recalibrate its peak rate to keep the pressure steady as opposed to letting it grow? I realize this is a fine point for the markets, and if you give if you say this the wrong way, they're all going to start pricing in rate cuts.
Look, it's possible, right? But at this point, we really need to see inflation moving down, and we're seeing early signs of that again. And I'm getting story after story from all our contacts that it is starting to happen. But I want to keep rates where they are right now, and then we'll decide later what we do.
What do you think is happening with labor market wages at this point? Because that was the big concern, especially with Jay Powell's non-housing services. These guys were talking about the United Auto Workers negotiations going on. Have we broken the back of rising wages rising at a too fast a pace?
Too early to tell right now, but it does seem like what I'm hearing from all our contacts is that it is starting to ease, right? I mean, we're not where we were, where mid-year increases are there. Nobody's considering that. So we are starting to see some easing, particularly in the service area, you know, hotels, restaurants, and so forth. We are starting to see it getting a little easier to get the table at the restaurant. And you know, and one of the things that I think about, one of the potential risks is that when student loan payments come back in, I don't think it's a big economic issue. I mean, when you run the numbers, it's not, but it's a psychological issue. Here, I've not gotten that $300, $400, $500 bill. Now I get it. And so I've been talking to a lot of people of that generation who are saying, yeah, you know, I may have to back off some of my spending.
Well, but this goes to this question of, okay, well, the savings are going to get borne down, and then we're going to start to see the real economy expose itself, right? A lot of people have questioned that. But I am wondering, what kind of neutral rate, what kind of, you know, sort of longer-term expectation for the Fed do you expect in the new normal? What does it look like?
Yeah, so we don't know for sure, right? Let's start there. We don't know exactly what that new normal looks like. But one of the things I think about is what's fundamentally shifted in the economy between before the pandemic and now. Remember before the pandemic, hard to remember for all of us, right, given what we've been through. But we had low interest rates, low unemployment, and low inflation. What's fundamentally shifted? There have been a lot of things. We're going to talk about this in this meeting. There's supply chain issues that are shifting and being re-engineered. But fundamentally, I think it's plausible that we can get back to that. No, I'm not predicting that right now, but it is plausible. So I think we have to realize that we lived in that world. We've proven that that can happen. And so could it happen again? Yes.
Sounds like a base case when I listen to you. Is that your base case?
I don't know. I mean, at this point, I'm not quite sure. But clearly, we're going to we'll get back to trend growth in a couple of years. We'll get inflation under control in a couple of years. And inflation and unemployment will tick up, but really in the 4-ish range, back to the neutral rate.
You've offered example after example in the last 8 minutes. It's highly anecdotal. Is the beige book now more important to us than U.S. retail sales?
When I step back and I think about myself, and I can only speak for myself, right? When we were going through the early part of the pandemic, and we were saying that inflation was transitory, it was just used vehicles and so forth, what I was hearing from my contacts was now really, it's more persistent. And I didn't factor that in. The mistake I made, if I made a mistake, was I didn't factor that really soft data, that anecdotal data. But it's more than anecdotal data. It's what people are really feeling real time in the economy. Now, we've done a lot of things, like done real-time pulse surveys and so forth to get ahead of that now. I don't want to make that same mistake twice. And so what I'm hearing right now from those same contacts is things seem to be slowing more than the data is showing. That could be wrong. That's why we have to, as Chair Powell said, risk management is an important issue here. But if they're right, if that soft data is right, then I think it really then just solidifies my view that we stay putting pressure on, not necessarily increasing right now, to see how that all resolves itself.
Nerd question for our friends on the trading desks out there, especially the bond guys. The balance sheet has been coming down, but very slowly because of the caps and the way that works. You haven't hit maximum reduction yet on a month-by-month basis. And at the same time, we have seen financial conditions remain easier than you would expect. So the question is, do you do more with the balance sheet because it has an effect on how tight the policy is?
At this point, I don't see us changing course on how we're reducing the balance sheet. Again, circumstances could dictate something else. But for right now, I think we just stay the course, keep that on, as I've said many times before, on autopilot. Just let it run. And if we need to adjust policy, we adjust that with the Fed funds rate.
Well, there has been a question on the other side of how close you are to stopping balance sheet reduction when you reach the level of demand.
Yeah, we don't know. I don't think we're there yet, but we do clearly have to monitor that. If you go back to the last time we did this, we knew we were at that point where we needed to stop when we saw the market indicators, the volatility in the market. We've not seen that yet, but we could.
We have seen real yields climb significantly. Today, 5-year real yields, inflation for adjusted yields, rose to the highest levels going back to 2008. Are you watching that closely as an indication of the transmission mechanism of the balance sheet runoff?
Sure. Yeah, I mean, that's one of many. It's also just simple trading and things like the Fed funds market and so forth. Not at this point. I mean, but it is clearly something we need to keep watching.
Can I finish on this? Slightly provocative. Have you destroyed the mortgage market in America for a generation?
I don't think so. I mean,
why not?
Well, it is clearly tough. When you talk to bankers...
Beyond tough. People are locked into mortgages at two handles for the rest of their lives.
First-time home buyer, really, really hard because there's no inventory. Right? Even if they could afford the mortgage, they can't find a home because people are locked into that low mortgage rate, in their existing home. That's why I think we don't keep going with rates, right? So that we can stay steady, and at some point, as we reduce rates, we can bring those mortgage rates back down. There's no question that's an issue.
But we're not going back to 2% mortgages over 30 years, are we?
Yeah.
So that inventory's offline, maybe for a generation.
Less.
You're not there yet?
Yeah, because what we're hearing from some of the home builders is they keep selling houses.
Oh, they're having a great time.
Yeah.
They're stock's having a great time.
Right,
We've done that a huge favour.
Yeah.
I'm talking about whether this housing market can really recover in the next several years, given that this feels quite generational. This feels like a really
but there's a lot of
time.
inventory coming online. I can tell you in Philadelphia and across many cities I know, but Philadelphia, for example, a lot of multifamily is coming online in the next few years. So we are increasing inventory.
Patrick, it's good to see you, as always. Thank you, sir. Patrick Harker, the Philadelphia Fed president. The first reaction there from inside the Federal Reserve following that speech from Chairman Powell in the last hour. Mike McKee, there's an individual that thinks we could just wait here, just keep the pressure on. But keeping the pressure on does not mean increasing interest rates any more than we already have.
Well, you asked me earlier whether the chairman was appealing to one side or the other, and I said in the middle. And at least we've heard from one side here that he doesn't think that Jay Powell is challenging him or making any case against what he's saying.
His point about the soft data is important, I think. And I think especially because anecdotally when I speak to small business owners who are my friends, they talk about how their lifeline is getting a lot shorter in terms of their flexibility and things that they used to be able to do with financing, they no longer can afford to do, especially with some of the other pressures.
So Mohammed Al-Arian, who got the inflation call right, I remember saying to him, what guided you? And what guided him is exactly what Patrick Harker just talked about. It was the responses from companies at the time who were saying, you need to take this more seriously. The conversation continues. Your equity market trying to recover, just about unchanged on the S&P.
What's happening on Wall Street?
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Today, European Central Bank President Christine Lagarde sits down with Bloomberg's Tom Keene for a conversation on the political economics of Europe and the permanent shifts in the global economy. Tune in for the exclusive interview live at 4 p.m. Eastern from Jackson Hole, only on Bloomberg.
After decelerating sharply over the past 18 months, the housing sector is showing signs of picking back up. Additional evidence of persistently above-trend growth could put further progress on inflation at risk and could warrant further tightening of monetary policy.
The chairman of the Federal Reserve System, Jerome Powell. This happens once every year, 40 years or more, at the meeting of the Kansas City Fed at Jackson Hole, Wyoming. We welcome all of you this morning. Jonathan Farrow, Lisa Bramwitz, and Tom Keene on radio, on television, truly worldwide today. Thank you so much for the comments. And what an interesting moment. As I was off set here with Mr. Harker with you. Lisa, this, more than any year I've been here, has been the most surprising year. And I can't believe I'm saying that after 08, 09, Lehman Brothers and all that.
It's a highly complicated moment for central banking and for fiscal and monetary policy making. And we're seeing all of these different economists and policymakers try to calibrate and not err on the wrong sides. You can feel like we're on a precipice of not knowing the other side, and everyone's grappling with how to really weigh in best.
The people are off camera. They're all waiting to meet you. I happened to stumble on one person who I was, and he was a doctor, and he's treating COVID. And we talked about the new discussions of COVID, and some of it's in the zeitgeist. Talked about the booster to come this fall. But I am adamant that COVID, the pandemic, still touches all that we're doing.
There's something that came clear after Patrick Harker speaking with us, the Philadelphia Fed president, which is the soft data, the conversations that people are having are less positive than the conversations that people may be having here economically about what the numbers are saying. And one key question is, what kind of ammunition do governments have to support an economy that does go into a downturn, given how much debt and given real yields? It's a hard time to see how they're going to come down to such a significant degree.
It's a 5% Atlanta GDP now Fed.
5.9%.
Discuss. Oh, sorry. I didn't get the decimal. We don't do decimal points at Jackson Hole. Okay,
it's almost 6%.
But come on, it's a 6% GDP economy. That's not a slowdown. I mean, it's just...
It's a reacceleration, which is causing a lot of angst for a lot of people.
Okay, we're going to continue forward here. We've got a lot coming up. Justin Wolfers will join us here in a bit. I believe he has a shingle from Michigan. We had to do better than that. The Kellogg School of Management right now. Janice Eberly joins us, professor of finance at Kellogg, and of course a former assistant secretary for economic policy at Treasury as well. Thank you so much. I flew in through O'Hare. And, you know, you go over the firmament of Northwestern, and to all of us of a certain vintage, and you've had the great honor of all the academics at Northwestern, of Robert Gordon and his ancient, iconic work on the growth of this nation and his doubt in recent decades over our sustained growth. Take the Gordon Northwestern view into all the policy work you've done about a confidence in American economic growth.
Well, Bob, of course, is iconic, and thank you for inviting me back here today. It's great to be with you. Bob Gordon is one of the stalwarts of Northwestern and the economics community more broadly, and he had a long set of papers questioning what the future of productivity growth would be like, that we'd had this boom, and we've seen a little bit of it in the papers already this morning, and what comes next. Though I will point out that a year ago, Bob had some work that showed some optimism, uncharacteristically, about productivity growth that was coming out of COVID.
Bring it into what you do. What you're famous for is how do we solve fractured policy? We can all agree that we have fractured policy in America right now. How do we coalesce our policy to get to a better growth, a better productivity?
Well, in the debate that we saw reflected a bit in the chair's remarks this morning, as Lisa was saying, it's a very complicated moment. And as the Fed is looking forward to what happens next, you see, a clear focus on the target, but also a little more of risk balancing than we saw, last year in particular, and a more nuanced message that reflects that at a 5% interest rate, and or higher, raising interest rates further is different than raising interest rates when they first got started. And that balance of risk, I think, reflects some of the complications that you were talking about.
There's also an issue and a complication here of what the potential casualty could be about going into a downturn, given the lack of potential fiscal stimulus that could really get pumped into a system, given the debt load and given how high financing costs are. How much does that create a more difficult scenario next time this nation, among many others, goes into recession?
So that's the short run. It creates a more difficult calculus for the Fed immediately because the increase in interest rates has more of an impact when the economy is weakening, when balance sheets are wavering more than they have in the past. So part of the reason we've had this surprising strength now is that we came into COVID with a pretty strong economy, and so it had less of an impact. But going forward, we can't count on that, and so the Fed's complicated decision-making reflects hard decision-making for families, for businesses, and the choices that are being made throughout the economy.
We were just talking about the mortgage market and how everybody locked in their 30-year, everyone who got smart and got ahead of this. The U.S. government did not do that. They did not lock in the longer-term, low-yielding debt. Is that a big problem? Why didn't they? Why didn't the U.S. sell more debt that was 30 years long and had a 2% coupon?
It's a combination of the Treasury and the Fed. I mean, the Treasury always has discussions about the maturity structure of the debt. And during a crisis, they're especially focused on providing liquidity. And that means going in and providing shorter run securities rather than longer run securities. So U.S. government debt tends to have a shorter maturity structure, partially because of its special role in the global economy. Mm-hmm. But there's clearly an awareness that there's a cost to that of not locking in the longer run rates.
One of the key things we know is Northwestern is closer to Wrigley Field than Chicago. I want to dovetail what Krosner's doing down at Chicago with what you're doing up at Northwestern. You and Randy Krosner are hardwired to pay attention to American business. How does American business react not only to the yield, but just the Newtonian calculus of a moonshot in T-bill, a moonshot in two-year yield? Some would dare say a moonshot right now in the real yield.
So, you're seeing already a market response to rising issuance, and that's really gotten people's attention because we haven't seen that kind of response certainly in the data that we've seen in our professional lives. And so that gives pause, and especially for businesses because their costs of capital are a premium on what looks to be or is close to a risk-free security. So it makes investment more costly. It makes debt coverage, debt service more costly for businesses. So that's going to lead them to pull back. And incidentally, that also can make the Fed's inflation fight harder because, ironically, the higher interest rates also, if they lower investment, say in lower residential construction, also put upward pressure on inflation. So that's part of the reason that the calculus is so hard now, because there's these counter flows and not just, the march up higher rates to try to fight inflation.
Professor, thank you so much. Greatly
My pleasure.
Pleasure
Thank
to have
you
you today. Janice Everly of Northwestern and Kellogg School of Management. Lisa, very quickly here, bonds, it's all anybody's talking about. These yields extraordinary.
Especially real yields. When you take out inflation, what you're looking at is new highs in this cycle, and that raises some questions about how restrictive that's going to be for the economy.
Giving you expertise on monetary policy here at Jackson Hole, Julia Coronado will join us, some macro policy perspectives. Stay with us worldwide at Jackson Hole. This is Bloomberg Surveillance.
maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Let's go straight into the price action this Friday morning. Going into the weekend, your equity market shaping up as follows on the S&P 500. On the NASDAQ, equities just about positive. We have been all over the place in the last 60 minutes or so. Call it the last 90 minutes. The S&P just about positive. The NASDAQ joining the party, heading towards a first week of gains for a while for the NASDAQ 100. Into the bond market following Jay Powell, the chairman of the Federal Reserve, speaking in the last 90 minutes, Tom, talking up the potential to do more, but also the job is not done, and we're committed to a 2% inflation target. Your two-year yield higher by 4 basis points to 5.0671% on a 2-year.
To Redux, 20 minutes ago, or was it 27 minutes ago, we did an overlay of wages UAW. I wonder if UAW has a little bit of dynamics going on here besides Jay Powell.
The potential for a strike, Tom, is a wrinkle in the story, that's for sure.
Yeah.
That's for sure. Lisa, we'll go back to a conversation we've had a few times. We've had the pay rises. We've had the union action. We haven't had the strikes.
Exactly.
And I don't think anyone wants to see those strikes anytime soon either.
Which has transmitted into this belief that labor has the upper hand, and that if labor has the upper hand, price increases can continue not just at union jobs, but more broadly. And that is the key question here. Is that going to continue so that you see a longer and higher inflation and a stronger and better economy for even with the rates that we see right now?
So it's time for the surveillance extrapolation. We do this every year at Jackson Hole. John, I'm trying to envision you, brown shorts, working your butt off at UPS, popping 170 all in.
That's so never going to happen, just to be very clear.
Why not? Why are you talking down the potential for this to happen?
If we put John...
Even our next guest is laughing.
Exactly.
Okay. Yes,
John,
exactly.
Lisa, if we put John at Flint, Michigan, building Buicks, what are you going to pop, 225?
Not sure.
You got to pay an auto worker more than a guy delivering boxes.
I want to see this guy wearing those brown shorts, and then we can have that discussion.
I'm not a shorts kind of guy. I think you know where I stand on shorts.
I know,
shorts are
that's
for the
why I'm
beach.
saying that.
This is serious
That's
stuff.
it.
This wage thing. Are we? Maybe it's a question for Lagarde. Are we going to come back to a more unionized European labor system? I don't believe it, but it's.
If we did, and I know we've discussed this a few times, but while we're here and the conversation has come up, if we had the same level of union membership we did back in the 1970s, can you imagine the pass-through into wages that we would have experienced?
Huge. 30 seconds before we get to our wonderful guest. My word for Jackson Hole, complexity. I did not think I would say that 2 days ago. That's the zeitgeist this morning, the complexity.
The speech I'm interested in, Chairman Powell, without a doubt, is the biggest speech for global markets. There's no dispute about that. But the speech I'm interested in is the one from Lagarde a little bit later.
I agree.
It's such a tough spot for the Europeans at the moment, looking at how the data's coming in. Inflation's still elevated. And over there at the ECB, you've got a single mandate central bank. with a lot of pressure coming from various parts of Europe. And what's been interesting for me is listening to some of the more hawkish central bankers not sound hawkish at all over in Europe. When you listen to people from the Bundesbank, yes, they're committed to getting to 2%. We know that. But are we hearing things like we need to go another 25, another 50? Their conversation's changed.
We're going to change the conversation right now as we shift from a discussion of Jerome Powell and the U.S. Fed to Bloomberg's coverage of Christine Lagarde. John, the speech here coming up in an hour, so I lose the time zones. But
Bramo's got it all written down.
We got the Lagarde speech soon, the Lagarde Q&A, and then we'll have our Bloomberg discussion with Christine Lagarde.
You're going to talk with her at
Yeah, I don't know when. My people know when. I don't know when.
4 p.m.
But the answer is, we're going to, right now, for this half hour, you need to stay with us. Coming up, Justin Wolfers will be with us from Michigan, and joining us from basically Texas with macro policy perspectives, Julia Coronado, who thinks we're going to talk Fed. But Dr. Coronado, we're going to shift this right forward to ECB.
Okay.
How much worser is it for Lagarde that makes her speech more important than what we heard from
It's
Chairman
a much
Powell?
tougher spot, as you just outlined. I mean, with the U.S., we have the beautiful combination of lower than expected inflation and better than expected economic growth. And Powell can just say, we're going to be patient and watch the data and do what we need to do. Lagarde has a tougher line to walk. You know, the data are weakening in a pretty alarming way, and inflation is yet still elevated. So how do you factor in lags and the nuances and the risks?
I'm going to interrupt right now because, John, it is a moment here at Jackson Hole, which is of importance when the lead central bankers come out to gaze at the Bloomberg surveillance set and to take a look at the mountains. John, why don't you identify the victims?
Well, let's go through this piece by piece, Tom. Chairman Powell, Governor Ueda, and President Lagarde. The United States, Japan, and Europe. And Tom, I think we can say 3 central bankers facing 3 very different issues. Julia Coronado just went through the United States. At the moment, Chairman Powell arguably in the better position of the 3. Robust growth, inflation, they're making progress, there's still work to do. Governor Ueda at the moment, Tom, inflation, arguably what they've been looking for the last several decades, and viewed as a once-in-a-generation opportunity to reset inflation expectations higher in Japan. And then you've got President Lagarde somewhere in between, where inflation is above target and growth is a problem. 3 central bankers, 3 different issues.
The symbolism of this post-pandemic is, I can state clearly, I have never seen this. We go back to Volcker in the 80s. I can't talk about those years, but for our American audience, this is a different central banker at the Bank of Japan. Mr. Ueda, very much American educated, wonderful command of English. He joins these central bankers, including Governor Bailey, with a real grasp of the linkages of Japan, Lisa, to the Western banks.
What this highlights to me is how everyone's grappling with the same mystery from very different vantage points and how interconnected the systems are. The idea of yields in the U.S. and the long end rising, some people say that Governor Ueda has more responsibility to do with that than Chair Powell. There is a question around how much they talk about this interconnectedness as they craft their policies.
There's nothing synchronized about this global economy right now, Tom. There's nothing synchronized about it. If we'd had this meeting between these 3 individuals a year or so ago, we'd maybe say that President Lagarde and Chairman Powell has a lot in common. They've got some work to do. Let's get inflation down. If we were coming out of the pandemic, I think we'd all sit around a table and say, we're on the same page, we're all working in the same direction. Are those 3 working in the same direction now?
No, I think there's completely 3 different subsets. And literally, ECB US, I would say there isn't a direction here as well. Justin Wolfers there shaking the hand of the chairman of the Federal Reserve. Mr. Wolfers will join us here in a moment so we can touch his hand as he is shaking the hand of Jerome Powell. Gazing at all this, including taking fan photos and selfies. Julia Coronado.
I can't help it.
This is not in the textbooks you studied in Texas. None of this.
No.
Just for our American audience, give us the foolishness in the textbooks of YCC in Japan.
the YCC is a tough one, and I think what we're seeing with Governor Ueda is the difficulty in the transition. That's always been the challenge with YCC, right? How do you get out of it once you've gotten into it? It's bound to be difficult and nonlinear. I think actually that they've managed pretty well so far, and that yes, as Lisa outlined, it definitely has had a spillover to the U.S. undeniably, right? I mean, we are all interconnected, and that has been part of the rise in long-term yields. And that may be a reality that we are facing with it. So maybe, Japan had been so entrenched dovish and bucking the global trend of inflation fighting. Now they're not. Now they're moving, and so that actually could make Powell and Lagarde's job easier, right? You've got higher yields. We've seen it in mortgage applications response. You're going to see it in auto lending and all kinds of credit channel effects from these higher yields. So maybe that patient approach means that we will see that housing market turn back down, and Powell, the Fed being able to remain on hold if these yields stay at these levels.
Europe, Julia, has been a fascinating case study when it comes to monetary policy. They've made the transmission away from all of that QE. I honestly thought that when President Lagarde backed away from some of that we might have problems on the periphery that didn't really materialize in Italy, Spain, Greece, and elsewhere. There's another really interesting case study that's developed this year. Germany.
Yeah.
Arguably going into recession, but still with an inflation problem.
Yeah.
What do you think we can learn from that?
Yeah, well, I think that one thing we're seeing is very different productivity dynamics, right? I think the U.S. we're starting to see a real dividend post-pandemic as the sand in the gears clears, and we're really seeing, if we are seeing labor demand, hiring cooling, and GDP tracking well above trend, that adds up to a whole lot of a productivity boost. Could be temporary, but we're not seeing that in Europe in the same way. So, the U.S. does tend to be a more flexible, dynamic economy in that sense. Maybe we're just getting more of a dividend on that front.
Do you think the United States is an island in that respect, given what's happening everywhere else?
I'm very reluctant about the decoupling notion, right? We are all ultimately intertwined, and our markets and our capital flows are all, we're all tied up together. So, maybe, hopefully Europe will catch up to us, not the other way around.
There is a concern about the soft data showing a very different story than the hard data. We heard that from Patrick Harker saying that the soft data suggests weakness that the hard data isn't reflecting. Is the hard data getting less and less accurate, regardless of the reasons why, of its response rate, of whether it's just, in terms of how it's calculated?
There are huge challenges with all the data. The response rates that you touch on have been an issue before the pandemic. That's even worse now. So I think it really does highlight the need to triangulate across all the data sources, the high frequency, the surveys, the hard data. The other mantra that I learned at the Fed was, who knows what GDP is in real time? Follow the labor market. We have so many good, solid labor market metrics. You look at hiring, it's still solid, but it's slowing. Aggregate hours worked are slowing. He touched on that. Labor supply is improving. We've seen a bit better, that kind of cooling off dynamic in the labor market data that isn't showing up in Q3 GDP. So again, that sort of favors that. Let's gather some more data, take some more time, look over a broader sweep of information.
Have we rejected the idea that being late is problematic? If we are late with raising rates sufficiently to curtail inflation, are we now rejecting the idea of embedded inflation expectations?
In terms of the fact that they were late, is that what you're asking?
In fact, the fact that they feel the confidence to be patient and that inflation won't become unmoored.
Right, yes. I think that they demonstrated last year was the year of regaining credibility, which they did by going very aggressively and sometimes surprisingly aggressively and showing, last year at Jackson Hole, and he touched at this at the beginning of his speech, he had to sort of smack the bond market upside the head and say, no, we really mean it. And it worked, and now the bond market's like fully buying into the Fed's higher for longer messaging, so he doesn't need to do that anymore. Again, if that turns around or if he sees that there are worrying signs of easing financial conditions, he can always readjust the message. But right now, it's just sort of hold the line. Yes, higher for longer. We think that's what it's going to take. I found it very interesting for him to describe the risks as a little bit of doing too much versus doing too little. He didn't say balanced, but he kind of put them side by side, Like we don't really want to crush the U.S. and global economies. We want to, you know, do this as well as we can, thread this needle as well as we can.
That's a change from last year.
Yeah, a big change from last year.
If you ask them what's the biggest risk, doing too little, doing too much, I think we know the answer.
Yeah.
If that's become more balanced, here's my question to you. Do you believe 2 is the goal? Do you believe 2% is the goal?
I think it's beyond Chair Powell's tenure to answer that question.
So I want your opinion.
Interesting.
Do you believe 2% is the goal?
I think that is absolutely what they're going to keep saying for until the next policy review.
That wasn't the question. Do you think it is the goal?
It really depends on the circumstances. Like, let's say we get inflation that stabilizes. I do think we need to get a 2 handle. Let me put it that way.
Okay.
Right.
And if we are stabilized around 2.5% and the economy's humming along, are you really going to break it?
Okay, Steve, come on out and bring me my Tang out here as well. I got one more question for Dr. Coronado. Let's cut to the chase. You're widely vetted with your academics as a potential governor of the Federal Reserve System. Would you like to see more dissent, Dr. Coronado, in this job interview at the Fed?
So setting all of that aside, I have enjoyed seeing a little bit more range of views. I think that's good and healthy, and I'm looking forward to seeing more of that. You know, you've got President Bostic coming out a little bit more, laying down the dovish line. Everything is relative. Nothing is dovish, right? It's higher for longer or even higher for even longer. But I think a range of views is very healthy. Very, very healthy.
Julia, this was wonderful. The catch up. Thank you. Julia Coronado of Macro Policy Perspective. 2 is kind of the goal. 2 point something, kind of, maybe, perhaps, at some point in the future.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Putting downward pressure on economic activity, hiring, and inflation. But we cannot identify with certainty the neutral rate of interest, and thus there is always uncertainty about the precise level of monetary policy restraint.
Fed Chair Jay Powell earlier on this morning in Jackson Hole, Wyoming. Live from Jackson Hole. Good morning to you all. The price action shaping up as follows this morning off the back of that speech. The S&P 500, I have to say, all over the place. Negative, then positive, and just about positive now by 0.25%. One move that stuck for about an hour longer was the move in the bond market. Now that fades, Bramo. Your 10-year 423. Can we look at the short end just quickly? Yeah. Bring up the 2-year because that came very close to a cycle high following this speech on a 2-year yield. The 2-year right now, 5.5%. 0.056%. TK still elevated this morning, but nowhere near where it was about an hour ago. Yields up there at the front end by 3 basis points.
John, these are the yields of my youth. I mean, I know we're going back to 2008, 2007, blah, blah, blah. We haven't seen this structure. And my number one question throughout the morning, how does corporate America adapt to this? I mean, if you're Apple and like clockwork, you come out with an X billion dollar refi to buy back shares, is Mester and Cook, are they sitting there right now going, maybe not this time?
The good news for them is that they did the adapting in the pandemic when interest rates were so low. They pushed that maturity wall out, and you'll get a lot of people in fixed income that will tell you now that's in 2025. They've done a lot of work, Tom, to make sure those balance sheets are super, super resilient. Then on the mortgage side, we know what's happened on the mortgage side. You've got people out there, Tom, on 30-year mortgages with 2 handles on them who aren't selling. The inventory's not coming back into the market. So what is the pass-through? We talked about this a lot. We know where rates are at 5.5%. The question you've got to ask is, who's paying them?
Lisa, are we popping 8% mortgages? Is that what we need to reframe as we stagger back to New York?
I think the mortgage market clearly is broken. I think that that's what we've learned in terms of the number of people actually taking out mortgages there.
Right.
The big takeaway that I've heard is who is going to suffer with these higher rates? Maybe some smaller businesses. From Patrick Harker. On the peripheries, you're hearing it more and more.
Strongly. I missed the Harker interview. Michael McKee did that, but I strongly take that point of the uniqueness of small business. We began hours ago in the dark, the cold and snow-filled morning of Jackson Hole with a gentleman from the Peterson Institute, Adam Posen. We finished strong with another gentleman, a senior fellow at the Peterson Institute. Justin Wolfers joins us now, professor of public policy and economics at Michigan. And this is finally at Jackson Hole, where we will have an R-Star discussion, because you studied with Blanchard and Alberto Alesina years and years ago. Blanchard has led the charge on trying to figure out where we're heading on R-Star. Take that we're going to return to low R-Star out to the gloom of an unanchored higher R-Star. Where do you see us, not in 1 year, 6 months, in 5 years?
I think it's the right question, Tom, because if you want to think about what really pins down long-term rates, it's not what the Fed's doing day to day, it's doing deviations around R-Star. So then the big question is, what is R-Star? Well, you could try and look it up on the terminal, but it's not there. And this is
Don't tell them.
Yeah, no, this is the difficulty, though, of macroeconomics, that so many of the variables that we think matter aren't observable. With R-Star, we got a million theories about it, but what we do know, or think we know, is over 4 decades it's declined. So what's your best guess for the next decade? Seems like a pretty good pattern. So Larry Summers has come out and he sort of thinks R-Star might be higher now. That's part of his campaign to get rates a little bit higher.
Said the same thing. Where is Justin Wolfers on this?
Mate, I reckon if you don't have a good idea about where something's going in a really solid story, you say things are just going to keep on being the same. And none of the stories I'm hearing seem particularly convincing, other than, I'm a macroeconomist with a view and I get paid to look confident. I don't want to overstate anyone else's confidence.
I've got to dig into that.
All right, mate.
You mentioned Larry Summers.
Yeah.
You think there's a campaign there to get interest rates higher at this Federal Reserve?
Oh, not in the cynical sense. Larry is a profoundly interesting economist, and Larry's a friend of mine too. What I'd say instead is Larry has a restless mind. Larry spent 5 years trying to convince us all that R-Star was lower. I didn't understand what he was talking about with secular stagnation for the first couple of years. I finally understood it, and at that point he changes his mind. So the argument and the evidence, I think, for his original secular stagnation thesis looks really pretty strong. Then what's the story that says Larry was right 5 years ago, and today's Larry thinks 5 years ago Larry is wrong? I think he got it right a few years ago.
So you think, just in terms of what we're going back to, pre-pandemic, low inflation, low growth, do you think that sticks?
So I'm glad that you put it in the context of the pandemic, because we all like talking about the post-pandemic economy. We all like talking and feeling like we're in a post-pandemic world. But if you start to think hard about like the interactions within the economy, the pandemic continues to exert a really important influence on the economy. And I think in ways that a lot of lay people and a lot of people on Wall Street don't think about. And I think there's an emotional part to that. I want to leave it behind. I want to stop thinking about it. And so I leave it out of my models. But the moment you think about labour supply, think about the return of women to the workforce, work from home, a fundamental transformation in the way we work, all the investments that didn't happen, the shift towards services, like are gyms going to continue to be important in the future? This is going to continue to shape the economy for another 2, 3, 4, 5 years.
Okay. I can dive into that.
But there's a question here.
Wait a minute. Wolfers runs the marathon like he's from Kenya. I mean, he's like completely cut and chiseled and in shape. He's worried about gyms in the future.
You've seen too many photos with my shirt off, Tom, and you should linger a little less.
All right, moving forward, there is a question. If it's going to take 4 or 5 years, does that mean that the prudent strategy for central banks is to sort of be more patient and to sort of let things happen without gunning it too much with rates?
I think it's that you want to be a little less model-driven. You want to be a little less sure of what's going on. I mean, this was obviously true in 2021. If you stood there in 2020 or 2021 and said, this is what my Phillips curve says, in a moment where we were shutting down economies around the world, that of course was crazy. Pandemic economies are different than normal economies. Economies recovering from a pandemic are also different in very interesting and important ways. And so that means you're a little less confident about what the model says and a little more looking at what the data says.
And which data are you looking at? Because we heard earlier that the data is flawed, the models are flawed. Do you now just do anecdotes?
Well, the economists are flawed too. But you know, the only thing that's more flawed is the critics. I've always said the single best defense of economics is that there's no better alternative. We are the least worst alternative you've got out there. So let me give an example of what I mean. Inflation right now is 3% and on the way down. You could look at your model and say, well, with unemployment at 3.5%, inflation's definitely going to be on the way back up. Or you could have a bit of a pause and say, I'm not quite sure the models are operating right now. In which case, I'm not quite sure that inflation's going to shoot back up again. And that's what I mean about being a little bit more driven by the data. Keep your eye on the things you actually care about and less on the intermediate variables that your models tell you should be focusing on.
I think we've all been humbled over the last few years, and I always say, Justin, that I'm in the cheap seats, that to be a critic of what's going on around me, we've all been humbled by what everyone has got wrong about going into the pandemic, coming out of the pandemic. Do you think that humility that's come about from that is good for the profession, good for economics?
What an utterly charming thought. Yes, humility is wonderful and a wonderful, wonderful strategy for economists. Now, have you met economists?
Many.
It's in very short supply. We get paid to look confident, to beat our chest, to... If I come on your show, and actually I just did, I apologize for this, and you say, hey, what's going to happen? I'm like, I don't really know. It's kind of hard to know. I got to guess, but I could be wrong. I'm not coming back on. And so that humility, I want to lay the challenge out to you. You want to inform your viewers? Then accept and embrace humility. And the next overconfident guest you have, shorten their segment, and the next person who says it's hard to know, lengthen theirs.
So limit Larry to like 4 minutes. 5? 5. Can we agree on 5? We'll agree on 5.
We'll go at 4.5.
You know what's great about Wolfers? He showed up here at the end of the show here before we go to Christine Lagarde. He showed up with a case of Swan's Draught. It's great. That's like this Australian beer.
Yeah.
It's a West Australian
Western
beer.
Australian beer.
Nice.
It's a beneficial. Yeah, Qantas turned me on that. It's great.
Guarantee you're back on soon. I'll send the invite in like the next couple of weeks.
I look forward to it.
For more than 4 minutes.
Absolutely.
Thank you, mate. Justin Wolfers there at the University of Michigan. That wraps it up for us, TK.
It does.
In Jackson, Wyoming. Until next year.
You got the Gulfstream, right?
Ready to go?
Yeah.
Jackson Airport. Going to race over there now. I wish.
You know, it's wonderful to have Christine Lagarde with us coming up after her important speech. But the real thing is, I'm a complete mystery what her speech is going to be. How does she address where she and Frankfurt are right now?
She is in a tough spot. Looking forward to the conversation with Tom Keene and Christine Lagarde later on this afternoon. From Jackson Hole, Wyoming, the message from Chairman Powell. There's more work to do. Good morning.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power of the ad.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow here in San
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Jackson Hole, well, it's not morning, afternoon, I guess now officially. We've just had the surveillance Jackson Hole coverage, 4 hours of it. Don't forget, more's coming later on today. Tom Keene sits down with Christine Lagarde for an exclusive interview at 4 p.m. on both Bloomberg Television and Bloomberg Radio. But we did have Jerome Powell coming out and doing exactly what I expected Jerome Powell
Much
was
ado
do.
about nothing, as Kevin
Absolutely.
Price, our markets columnist, put it.
Simone Foxman is joining me. Paul Sweeney is at the Sweeney Estate on the, well, I'm not supposed to talk about the Jersey Shore, but that's, I assume, where he is. And yeah, we're looking at a market that hasn't really shown a ton of reaction. Before we went into the Jay Powell speech, I saw the U.S. 10-year hovering just under 425 at like 424.53, and right now it's trading at 424.53.
I think the only thing that's really showed more movement was the 2-year. But I guess we kind of knew the message was going to be higher for longer. It's just how much higher for longer.
I mean, the message is higher for longer. It's been higher for longer. September was a live meeting. The dot plot shows another hike. I mean, aren't people paying any attention at all? Let's get over to Charlie Pellet right now. He's got your Bloomberg Business Flash.
Hi, thank you very much. And here's what's going on. Right to the numbers here. A Jay Powell Friday, a Jackson Hole Friday with the S&P now up by 5 points, has been fluctuating, up now by 0.1%. We've got the Dow up 118, up by about 0.4%. NASDAQ lower by 7, also has been fluctuating, down by about 0.1%. The 10-year, 4.24%, with the 2-year, 5.06%. Powell saying here on Bloomberg Radio the central bank is prepared to raise rates further if needed and intends to keep borrowing costs high until inflation is on a convincing path toward the Fed's 2% target.
Although inflation has moved down from its peak, a welcome development, it remains too high. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective.
Reaction to Powell's speech from Bloomberg opinion columnist Mohammed El-Arian, who is also the president of Queen's College, Cambridge.
It's a speech that said very little that is new. He repeated what he has said in the past, and he has retained maximum policy optionality.
And you can hear more of that conversation on the Bloomberg Surveillance podcast. You can download it wherever you get your podcasts. And, of course, a lot more reaction coming up right here on Bloomberg Markets. Spot gold lower by $8.50 the ounce, now at $19.08, down by about 0.4%. West Texas Intermediate crude up 0.6%, $79.52 a barrel. Bitcoin at $25,930 now, down by about 0.3%. Briefly after earnings, Gap shares, they're up now by 2.9%. Nordstrom after earnings down by 10.8%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thanks very much for that. Matt Miller here in the Interactive Broker Studio with Simone Foxman. Paul Sweeney is on assignment. We just finished our 4-hour Jackson Hole special coverage, the surveillance team out there in Wyoming with Jerome Powell and Christine Lagarde and all of the most important central bankers in the world. But we got absolutely no reaction to the speech. I mean, even futures were up 0.25%, and now we're looking at an S&P 500 that's up 0.3%. So,
I mean, they were down for a second. There was this moment where everyone was like, oh, this is a hawkish speech. And everyone's like, wait a second.
Okay, I stopped watching markets at 8 a.m. and just started again at noon. So, you know, I don't know what happened in the past 4 hours in terms of the numbers, but they look the same to me. Let's bring in Liz McCormick. She is our chief correspondent for global macro markets over at Bloomberg News. And Joe Weisenthal, host, you know him as the host of the Odd Lots podcast. I know him as the host of What'd You Miss? It's a show I deeply miss. That's what I miss, is that show. In any case, I want to get the take of both of you. Liz, I'll ask you first because I couldn't sleep last night. I woke up like in the middle of the night and I read your fantastic story on the increasing and increasingly scary government deficits and interest payments. What did you think about Powell's speech?
Well, I think Powell, like you guys were saying, I think he did what he wanted. He wants to leave himself like Mohammed Al-Arian and said full optionality. He's not boxing himself into a corner. He didn't give at all on, they're going to give up on the 2% target. The job isn't done. He noted a few good things, where inflation's come down. But I think he doesn't want to give any signal, like markets pricing. He's not going to do anything in September, him and his folks. But that there could be more. And I think him saying, if things remain resilient, we could do more, it just kind of goes in line with all these predictions. I think, we will see what happens, and it's all about the data, right? If the data comes out stronger, inflation picks up, they could do more. Like Craig Torres always tells me, they'll do whatever they want, Yeah.
Well, I want to talk. We had a story out from our Ruth Carson about the R-star, the theoretical level at which rates neither stimulate nor restrict an economy. And Jay Powell did have something tiny to say about that. He said we cannot identify with certainty the neutral rate of interest.
And we've never been able to, right? It's an abstract number. It's theoretical. It's ephemeral. I mean, all of a sudden people are acting like R-star is calculable.
Well,
I don't understand what this debate. Where has this debate coming from?
Well, Joe, that's why I want to bring you in. What is the rate of the neutral rate here?
All right, you ready for my big number? I'm going to
Yes.
reveal. I'm going to reveal the new. I heard it was 2.5. I think it may be 2.55% now. No, I have no idea. But what's interesting to me is that it's prior to the speech. Everyone's like, "Well, what's the buzz in Jackson Hole? What do people talk about?" And people are like, "Oh, is he going to give a speech about like where R-star is now and something theoretical, or is he going to maybe talk about productivity gains?" Like, this is an academic conference in theory. Last year, he sort of, Powell's speech was like almost infamously short, like 8 minutes. And he's just like, we're not here to make friends. We're just here to, get inflation down. And so this year was like basically the same thing. And it's once again, he sort of passed on the opportunity to deliver some like theoretical academic monetary policy speech. And he basically said, this time in a few more words, but not, we're still just, our job is to get inflation down. And, there's some progress and there's some signs of encouragement, but it's still too high and there's still more work to do. So I do think it's interesting that while people have these discussions about what is R-star and can we know it in real time and is this a useful guide, he did not come here to address that question. And to the extent he did talk about stars, he's like, well, it's a cloudy sky, so we probably can't see the stars anywhere.
But Joe, we know what we don't know, right? We know we can't know R-star in real time. Everyone, I've never thought of this as a number someone could pinpoint. Even he's not a theoretical academic, Jay Powell. So especially he doesn't know what it is.
Well, bond investors, that's what they do. They would say, hey, we're trying to figure out our bond math, this is what we price off of. It's our biz, so we're going to make an estimate. People are watching. I think Joe has talked about this before. The dots, we know the median is stayed at 2.5, and that's the nominal neutral rate, but the average is moving up. So that's what bond people do, right? They're supposed to be ahead of the game. But I think you're right. I mean, I come from a math background. Things like even term premium is a residual, stuff that's, that you can't pinpoint estimate, but the bond people, that's what they're about, kind of speculating and doing their models and whatnot.
Yeah, was there any sign that like the long-term dot plot has changed at all in this speech?
Well, no, not in this speech, but I will say, the quarterly economic figures they put out with the dot plot. People have looked at, we always flash, the median is 2.5, has stayed there for a bit now, but that the average, if you take the average, there's a few more policymakers that have bumped it up a little, like Joe's saying, 2.55, so it's...
But you're taking what, the median dot and then taking out inflation?
Well, yeah. So if you take the median dot, which is a nominal rate, and 2.5,
which is
usually,
like
and you say the Fed's
at year end, right?
Yeah, but if you say the Fed's 2% inflation, that's like a neutral real rate of about 50 basis points, right? That's kind of the going rate. So bond people are saying maybe it's going to tick up a little higher with the long run dot to show us maybe they think neutral is higher. Who knows? But I think I said we have to talk about this because nothing against stock people, but everybody and their brother, stock people, you name it, are talking about R-star, like you said. It's something like no one gave a hoot about.
I mean, I always try and guess, and on the Bloomberg terminal, we have a great Taylor rule function, and you have to put in your neutral real rate guesstimate there, which is part of the fun of it, and also the most infuriating part of it, I think. The NARU too. Like, it's another one of those numbers that we just don't really know, right, Joe?
But yeah, I mean, look, you will not get any real disagreement with anyone's like, oh, like no one. You would be hard pressed to find someone who could like really say, oh, this is the number and we know it in real time, etc. But in the defense, if I were going to like mount some sort of defense of the concept, it's like, well, the economy feels different today in 2023 than it did in 2013. And what are some reasons? Well, we did get this like really different fiscal response to the crisis that we saw, of COVID versus the fiscal response that we got to the great financial crisis and so forth. So there are some structural differences, it would seem. The labor market was really tons of slack over the 2010s. Now we talk about labor market tightness, maybe some demographic changes, maybe some changes in the nature of world trade. And whether there's this sort of ongoing disinflationary trend. So I don't think many people are going to say, okay, we know this number in real time, but is an exercise to think, well, could we have structurally higher rates because of some fundamental difference in macro, particularly around globalization, particularly around fiscal? I don't think it's like a crazy conversation to have. And also, furthermore, this idea that maybe like after, we sort of got anchored to this ZERP era in our minds where everyone's like, well, that was the normal and rates are going to come down. And of course, like we know the 2010s were sort of a historical aberration. Maybe it could be more like the 80s. Maybe it could be more like the 90s. We don't know. So I think maybe there is some value in discussing, did something structural change about the macro landscape globally or in the United States that would say, you know what, we are going to have higher rates for longer than we would have expected. What are those conditions? And maybe that is a fruitful conversation to have.
Of course, that's fair. And I think, I can't remember the name exactly of the Jackson Hole Symposium, but it's like, I think the name is something structural change.
It's structural.
And, we heard Jim Bullard talking to Mike McKee yesterday, and he did say he thinks we're in a new inflation regime, a new interest rate regime. But I think we all agree on that already. I thought, this R-star thing, Claudia Sahm told Tom Keene a couple days ago, she of the Sahm rule. I can't remember where she went to grad school, but she went to Denison University, which makes me pretty proud. But she said that was, to her, the most interesting debate at Jackson Hole was, where is R-star? And that's when I started to think things are getting a little weird.
Well, I mean, you talk about a paradigm shift, though. I was looking at the 30-year yield, and we're back close to where we were in 2011. I mean, are we just going back, like, a decade plus, but not to the 90s or to the 80s, if that's where we're talking about where long-term yields are, and maybe put this in the context.
Well, mortgage rates are where they were. When was the mortgage rate last at 7.5?
I think that was early 2000s.
Yeah,
I believe. I forget which year, but I mean, is there a prospect that we, as with home buyers, simply adjust slowly over time to like slightly higher rates? And what does that mean? What do you think that means, Liz?
Yeah, I think I was going to bring that up. That I think that's the broader picture besides this R-star gazing, is that there's a lot of people like Bill Dudley has written about that feel like overall the system is going to have structurally higher rates for longer, meaning, we're not going to go, like, so we're saying, oh, we're at the highest rate since 2007 in certain tenors and treasuries and whatnot, but, that maybe we're supposed to be there, that things have changed. Part of a little bit what Joe was saying, that we're, maybe inflation's going to stay sticky. Even in the Fed's forecast, they don't get to their 2% goal for several years, right? So if rates have to stay higher, that may be that we all have to get used to saying, oh, my home equity line is now at 7 3/4.
But it's not 17. You know, it's not
Yeah,
17,
exactly.
20%
Right.
where we were in the
Well,
60s,
that's
80s.
right. That's what I mean.
Yeah.
You're just going to adjust and say, maybe I'll do these 3 things in my house, but not that one. But, you know, some people are, you know, it depends on where you are. Some people are having trouble keeping up with things, of course, you know.
Joe, what I think is most interesting is a debate about what the inflation target should be. And I'm not saying I think it should change because, or that it's really a special number at 2%. I just think it's interesting when people talk about it. I think, you know, I don't like inflation. I think it's a regressive tax, but that's just my opinion. It could be any target. What do you think?
Yeah, I think it's a really interesting question. I mean, Powell is sort of adamant today that he's like, we're not changing the inflation target, probably because of buzz of people in the media. You know, there was a Jason Furman column. He's like, maybe we should go to 3%. It feels kind of academic. And I think there, in terms of like, look, the way I think about it is this. 3 years ago at Jackson Hole, it was virtual that year in 2020, but 3 years ago at Jackson Hole, the Fed laid out its new framework, flexible average inflation targeting, which essentially said that we're willing to accept some trade-off. We're willing to accept some higher inflation in exchange for a more rapid pace of labor market healing. That's basically what it was. And so I think when you see these conversations about a higher inflation target and whether the Fed should tolerate 3% or 2.5%, et cetera, it's essentially asking the same question, which is, we have a good labor market right now. It's great, 3.5% unemployment. That's really encouraging. The spread between black and white unemployment has narrowed quite a bit. Wages at the low end of the income scale are growing faster than high end. These are all things that I think people have generally wanted to see for a while. So when the conversation happens about should we tolerate higher inflation, to me, the real question is like, how much are we willing to sacrifice on the inflation side in order to keep the good news on the employment side? And so I think that is sort of what this question is about. It's like 2% isn't fixed in stone. It's a sense of like what low and stable inflation looks like. But given where we are on employment, should we tolerate, how stressed should we be about some periods where we're a little bit above that, or 3% or 3.5%? Do we want to preserve what we have in the labor market? And this, I think, is the sort of real question. How much are we willing to sacrifice of what we've achieved on the labor market side to get back to 2% is, like, to me, the question that really we're really discussing when we talk about raising the inflation target.
Joe, great talking to you. Thanks so much for joining us. Joe Weisenthal, who co-hosts Odd Lots, of course, with Tracy Alloway. Liz McCormick, always a pleasure to have you in the studio. I highly recommend everyone reads her story. U.S. budget deficits are exploding with no end in sight. This is Bloomberg. Let's get over to Lisa Mateo right now. She's got our company news. Lisa?
You got it, Matt. Shares of Hawaiian Electric are lower after the company made a move indicating possible financial distress. Bloomberg's Jeff Bellinger has that story.
Lisa, Hawaiian Electric Industries and its Hawaiian Electric Utility Unit drew $170 million and $200 million, respectively, on their revolving credit lines. The utility company also suspended its dividend payout starting in the third quarter to preserve cash. Hawaiian Electric has come under scrutiny for the role its power lines may have played in sparking the deadly Maui fires.
And shares of Hawaiian Electric right now down about 17%. Is the rally for NVIDIA over? Morgan Stanley's Mike Wilson says yesterday's decline in the S&P 500 is a sign.
Markets top on good news, and they bottom on bad news. Well, I can't think of any better news than what we got from that company on Wednesday night. And we had the failed rally. So that, to us, is another negative technical signal that the rally is exhausted.
And shares on NVIDIA right now down about 4%. Well, some good news and some bad news for Nordstrom. Bloomberg's Gina Cervetti explains.
Nordstrom's off-price rack stores saw sales falling less than expected last quarter, and that helped the company beat its net revenue estimates. The retailer also reaffirmed its outlook for the current year. But Nordstrom joined other retailers in pointing to increased theft as a problem. The CEO said losses from theft are at a historic high.
All right, and shares of Nordstrom right now, they're down about 10%. And the latest quarterly results from Gap fell short of estimates. The numbers did suggest the retailer's new CEO, Richard Dixon, has some work to do.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long at Bloomberg. The Dow, the S&P, NASDAQ are all advancing. The NASDAQ 100 index, though, in the red. Right now, we have got the S&P up 9, higher by 0.2%. The Dow up 149, higher by 0.4%. NASDAQ up 12. That is a gain of 0.1%. 10-year yield 4.24% on this Jackson Hole Friday. We've got the 2-year yielding 5.06%. Spot gold down $6.50 the ounce to $19.10. A drop there of just about 0.4% now. West Texas Intermediate crude up 1%, $79.82 a barrel, still below $80 a barrel. Stocks have been fluctuating. Yes, we're in the green right now after Jay Powell signaled it is still too soon to declare victory over inflation, while saying the Federal Reserve will proceed carefully on whether to raise interest rates again. Auto workers have overwhelmingly voted to give union leaders the authority to call strikes against Detroit car companies if a contract agreement is not reached. The UAW says 97% have voted in favor of authorizing one or more strikes against Stellantis, General Motors, and Ford. Stellantis shares up 1.3% right now. GM down 0.3%. Ford shares are up by 1.1%. Again, recapping, stocks higher. S&P up 13, up 0.3%. The 10-year 4.24%, with a 2-year 5.06%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie, thanks very much. Charlie Pellet there with your Bloomberg Business Flash. Matt Miller here in the Interactive Broker Studio with Simone Foxman. Paul Sweeney is on assignment today. And what a day to be off, because
the most important speech of the week, month, summer? I don't know.
I was going to go the other way. I was going to say, what a day to be off. Markets are doing a whole lot of nothing, and Jerome Powell just repeated in his Jackson Hole speech the same thing he said at the last Fed speech.
I was going to say it would have been a disappointment, I guess, to stick around on a summer day.
Let's bring in someone who does this for a living. RJ Gallo, Senior Portfolio Manager at Federated Hermes, joins us. Am I being too glib, RJ, because it doesn't seem like Powell moved markets much, and my opinion of what the Fed is going to do, my guess, my forecast is just the same today as it was yesterday.
I think that the anticipation for the speech was that it wouldn't necessarily be a seminal message like it was a year ago, which was a really aggressive and powerful message to the markets that we're tightening, and we're tightening a lot. That was a year ago intended to rebuild their credibility as an inflation fighter, and I think that has worked. Here we are in August of 2023. I think we expected sort of an agnostic, cautious speech. I think that's what we got. It has a little teeny bit of a hawkish tilt to it, and as a result, 2-year yields are a little cheaper. The Treasury yield curve is a little flatter because of that sort of hawkish message that we'll tighten again if we need to. But it's a cautious message because he also emphasizes the risk of doing too much versus the risk of doing too little, repeating some other messages that he's said before, as you noted. I think that there's some information in the speech, maybe most notably the line where he basically says the 2% inflation target is the 2% inflation target. He's trying to push back, I think, on media speculation and market speculation that the Fed will want to increase its inflation target over time. That was probably a subtle but important point that was added here for specific purposes, I believe.
One thing that did change, the Fed swaps beginning to price out the first 25 basis point rate cut, whopping next June, moving to next July. I mean, does that change your positioning in treasuries at all? Does that make you any less eager to purchase, I think, medium to long-term duration, or is this sort of just all noise here for you?
I think we're living in a challenging time. Many on Wall Street, many investors have been expecting that the cumulative impact of the aggressive Fed tightening would have produced a sharp growth slowdown, perhaps a recession by now. That had been our internal call within Federated Hermes Fixed Income. We've positioned to lean a little bit long duration and up in quality, reducing weightings in high yield and investment grade, for example, to underweight positions in anticipation of that economic outcome. And it has not happened. The economy has not just been resilient, it's been strong, supported by the consumer, supported by government spending. Inflation, fortunately, has come down. Otherwise, yields would be a heck of a lot higher than they are today. Imagine what yields would look like if inflation was still 6, 7, or 8%, and the economy was plugging along at high rates, relatively high rates of growth. So the inflation story has worked, but the recession outcome has not. Our view is ultimately we are going to see some diminished growth path. We keep pushing that back. Today's news doesn't change our positioning per se, but I think it does emphasize the degree to which the Fed is very committed to seeing inflation return back close to its 2% target. And that means they're not in a hurry to ease. They anticipate there'll be some easing in growth. Powell explicitly talked about jolts weakening in his comments today. He also talked about the lower rate of non-farm payroll job creation that we've been seeing recently. Positive, yes, but at lower pace. And I think on net, the news today was not hugely market moving, but it doesn't change our view. We still lean a little long. We're still up in quality. We think that growth slowdown will come.
Yeah, a couple days ago, I was talking to Michael Darda over at MKM, and he said, we were talking about high yield. He said he thinks junk is, his words, insanely expensive. And when I look at delinquencies, any chart or credit card usage, it just goes up and to the right recently. Are you expecting to see more defaults? Shouldn't investors get more more reward for that kind of risk?
That's part of the reason why we are, in fact, up in quality. We think on the macro front, the consumer has been spending at a breakneck pace, and they're pulling down on the COVID era excess savings, I think we call it these days. Eventually, that's going to run pretty thin for mid and lower income households. We're bringing back the student loan payments. That's going to have some impact. So we think the consumer is going to fade. With respect to high yield, we think the valuations are too tight. We were underweight during the rally. We've missed some of that, admittedly, but we're not going to chase it now. We think that because the fundamentals should weaken and we think there will be some uptick in defaults, that we want to see wider spreads before we start getting back in more constructive on high yield.
You know, we were talking with our chief economics correspondent, or I think that's her title, Liz McCormick, just a few minutes ago, and she had a great piece out about how U.S. budget deficits exploding, no end in sight, and there are economists very worried about the potential for that to drive up Treasury yields in the long term. But there's sort of this interplay, right, around what the Fed wants to do versus the U.S. fiscal health. I mean, do you see that having any impact when you think about the kinds of risk you're taking in the long term?
Yeah, no, when we develop our duration call, I'm the head of our duration committee, and our duration call expressed as a percentage of index, long or short, is predicated clearly on our monetary policy outlook, but fiscal policy is another key ingredient in the discussions about how we're going to manage duration. And on the fiscal front, bottom line is the U.S. government is spending quite a bit more money than it takes in. That's been the case now for quite a while. That was true before the pandemic. It remains true after the pandemic. Neither party seems to really believe in fiscal discipline when they actually have the control of Washington. We saw that when the Republicans had complete control during the early Trump years. They just spent more and taxed less, and the deficit went up. Eventually, this is going to have to turn. But for now, I think there is a difficult challenge where the Fed is trying to restrain the economy and bring down inflation with their policy, aggressive policy stance, shrinking the balance sheet, raising rates. Meanwhile, fiscal policy, on the other hand, is net stimulative through the tax credits linked to the green energy spend that was part of the Inflation Reduction Act, as well as the infrastructure bill, which was very bipartisan. So the federal government is doing some things that arguably they probably need to do. If we're going to do some transition to how we become a more green economy, that's going to cost money. If we're going to have rebuild and expanded infrastructure in a country that needs some of that, that's going to cost money. But of course, it's coming at a time when the economy is already running pretty hot. And so it is working at cross purposes with the Fed to some degree. And that's why our duration long, we're not max long. We're not even a quarter max long. We're leaning long because we think that fixed income is repriced to the point now where it creates value to investors as income is real in a real sense, net of inflation expectations. And we think ultimately some slowdown in the economy will occur. But the fiscal stance is going to support the economy while the monetary stance is trying to restrain it.
How slow, how bad do you think it'll be, RJ?
We had previously thought that, there were some in our, we're a team, and there's some members of the team who felt that we were going to have a potentially deep recession, especially last spring when SVB was blowing up. It felt like the early signs of a true crisis brewing. Maybe not as bad as a Lehman Brothers global financial crisis, but something that was going to be very stressful and lead to a deeper downturn. I think when you look at it now, consumers are strong, jobs are plentiful. We think it's going to be a modest recession. I wouldn't be surprised if we get, the traditional 2 quarters of GDP contraction, but the NBER should see jobs and retail sales, and all the components that they look at to officially call a recession sufficiently tip over to the point where we have a mild recession that's not long lasting. In a world like that, we're not expecting the Fed to go back to the zero lower bound. We're not expecting the 10-year Treasury to have a 2 handle again. Wouldn't mind it if it got a 3 handle, but it's a cyclical downturn, not a big seminal event like a financial crisis.
Right.
RJ, great having you in the program. Thanks so much. Really appreciate your insight. RJ Gallo there from Federated Hermes. Let's get down to Nancy Lyons right now in Washington, D.C. She's got your world and national news.
Thanks, Matt. The deadline has come and gone for the 19 defendants in the Georgia election case to surrender at the Fulton County Jail, and all of them met that deadline. Last night, Donald Trump turned himself in and had a mugshot taken. Bloomberg's Anne-Marie Hordern says he's already capitalizing on that fact.
Within really minutes, you had his Super PAC campaign putting out fundraising alerts, and they're selling his mugshot on T-shirts for $34. So they are already monetizing this.
Bloomberg's Anne-Marie Hordern says some of the money raised will be going into Trump's legal defense fund. A new poll indicates most Americans think former President Trump should stand trial before next year's presidential election. The Politico Ipsos poll shows 62% of those surveyed say the classified documents case should go to trial before the election. 61% said the same about the election interference case. The death toll from the wildfire that destroyed Maui's historic town of Lahaina currently stands at 115 people, but hundreds more are missing. Maui County has now released a validated list compiled by the FBI of 388 people who remain unaccounted for. This is Police Chief John Pelletier.
The validated list has a criteria. It's very simple. It's a first and last name and a point of contact of who provided that name. Therefore, the 388, we are asking, if you're on this list, please contact the FBI number provided.
That number is 808-566-4300. Again, 808-566-4300. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are rebounding with the Dow, the S&P, NASDAQ, and now the Russell 2000 all solidly in the green. Traders are sifting through comments from a raft of Federal Reserve speakers after Jay Powell said officials will proceed carefully on whether to raise rates again while signaling policy will remain tighter for longer. You heard the speech live right here on Bloomberg Radio.
Although inflation has moved down from its peak, a welcome development, it remains too high. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective.
Reaction to Powell's remarks from R.J. Gallo, Senior Portfolio Manager at Federated Investment Management, who was interviewed moments ago right here on Bloomberg Markets.
I think we expected sort of an agnostic, cautious speech. I think that's what we got. It has a little teeny bit of a hawkish tilt to it, and as a result, two-year yields are a little cheaper. The Treasury yield curve is a little flatter because of that sort of hawkish message that we'll tighten again if we need to. But it's a cautious message.
And you can hear more of that conversation with R.J. Gallo of Federated Hermes on the Tape podcast. You can download it wherever you get your podcasts. So here is where we stand right now with the 10-year yielding 4.23%. The 2-year, 5.06%. S&P up 16, up 0.4%. The Dow up 181, up 0.5. NASDAQ higher by 0.3%. Spot gold down 0.3%, 19.10 the ounce. West Texas Intermediate crude up 0.7%, 79.63 a barrel. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charles, thanks very much. Charlie Pellet there with the Bloomberg Business Flash. Now, we are looking at markets doing a heck of a lot of nothing today. I mean, we're up 0.5% on the S&P 500, but we were down 1.5% on the S&P 500 yesterday. And
market's going.
We don't see any response to the Jackson Hole speech in the bond market either. The 10-year yield is unchanged at 4.24. I guess on the shorter end, the 2-year yield is up 3.5 basis points at 5.058.
It was up more. I feel like we've seen this enthusiasm.
It just seemed to me like he was reinforcing the things that he's already said so many times.
I'm not really sure why investors seem to doubt him so much. He says he's not going to cut anytime soon. They don't think it, and then here we go.
Let's ask a professional investor.
Yes.
Caterina Simonetti joins us right now. She is the Senior Vice President, Private Wealth Advisor over at Morgan Stanley. And Caterina, the one thing that I look to that's a little confusing is the dot plot. And I know it's not supposed to be a forecast, but these are, essentially the Fed participants' own individual forecasts, and they call for 4 cuts next year if we get another hike. On the other hand, Powell has said rates are going to stay this high for years, and everybody seems to know that unless something breaks, they're not going to cut. What do you think?
Well, Matt, thank you for having me on the show. It's a challenging time, and you're right. He hasn't really said anything new. We see inflation coming down, and that means that the Fed is nearing the rate hike cycle. But does it actually mean that it justifies the valuations that we have seen and the growth that we have seen earlier this year? And whether they're going to continue really depends on the data. But investors seems to be a little bit distrustful of the messaging because it took Fed such a long time to react to inflation and that transitory message that we all heard so much about. But eventually they're going to be done. The question is, are they going to pause first or actually continue to raise rates for a little while longer? But when we look at the yield curve and we see higher rates at the longer side of the yield curve, that does point out that the rates might be staying longer for higher for longer, that plus the Treasury overissuance that we're seeing so far. So we have to incorporate that into our reality and translate it into market expectations.
Well, we've got a couple weeks before our next Fed meeting. There is, when you look at the swaps market, it is pricing in a 21% chance that we could see a second hike here. November's a little bit higher. What's your take? What would we need to see to actually change those expectations, make that a real thing?
Well, the earnings are slowing, and that's a good thing. And inflation is coming down. So Fed is seeing a lot of the data that they're hoping to see. But at 3%, they're really not close to the target number. So there is a possibility that they might continue, to hike rates. But whether they do or not, if we take the larger picture into consideration, they're nearing the end. Sooner rather than later, they're going to be done, and eventually they're going to pause. What I like personally is that we kind of stopped talking on some level about the rate cuts, because we need to concentrate on here and now. We still have to get through the end of the year. In market, to us, it's going to look slightly different in the second half than it did in the first half, because again, are the valuations that we have seen, the growth that we have seen only in select areas and in this very select names, was it actually justified, or perhaps it was overly optimistic, which is the way it seems to us.
We heard some interesting statements yesterday from Nikki Haley, former governor of South Carolina. She's running for president, concerning the retirement age. And I wonder what you take from those statements. I mean, it's going to be a drastic change, though not necessarily unexpected or difficult to understand if we raise the retirement age here in the U.S. What does that mean for some of your clients?
Well, our clients are concerned because, on one side, of course, nobody likes that notion of kicking the can down the road and taking the responsibility of funding the retirement benefits for our retirees, to the next generation. But at the same time, we have to be responsible, and we have to take a close look, at the numbers, because on our side, we see investors, on one side, really hoping for the short landing, for the soft landing, I apologize, but also being very cautious of the market, because so much of the retirement income has to come from personal savings. Now, good news, of course, is that we are in the high interest rate environment, and then investors right now can get higher yields, in anything from money market to, any area of fixed income. But retirement age is a big subject, and it should be addressed sooner rather than later.
What do you think is appropriate for a retirement age? I ask this because I see you listed as the corporate retirement director at Morgan Stanley.
Well, of course, and if the calculation is based on the actuarial assumptions, and the way that the Social Security is funded. So it's not an easy question to answer, but on my side, as financial planner, we will plan for any age. We just need to understand what retirees, should be preparing for. But it's a really larger conversation and a big, complicated calculation.
I'm planning to retire when I'm let's see, I'm having a kid in November. I'll be 50, so she'll be done with college when she's 20. So I think I'll retire around 72. That makes sense to me.
That would be a significant hike from where the expectation is. I think
maybe 75. I may have to work a little bit longer, actually, now that I think about it. College costs,
Yeah, it's tough. I mean, all right, so give us quickly, I think we only have about 30 seconds here. Where are you putting your marginal dollar for your clients at the moment?
Simone, we tell investors to be defensive, to stay with quality, with large cap in the areas like, industrials and financials, healthcare, materials, to look at dividend income, and, to flight to safety. It's not a bad thing when interest rates are this high, so we are cautioning our clients to be defensive until, things normalize a little bit, until at least through the end of the year.
All right, Katerina, great to get your take. Thanks so much for joining us on the all-important Jackson Hole Speech Day. Katerina Simonetti there. She is Senior Vice President and a Senior Portfolio member, as well as Corporate Retirement Director over at Morgan Stanley.
And this whole labor discussion, I mean, between the retirement age and between the higher, some of the activity that we see with the United Auto Workers and
the wages. Well, it started with Deere, then we got UPS, now the UAW.
And the idea that this is such a huge factor in inflation is just higher wages, to me, to some degree, seems like I don't know, a good thing that we're finally catching up on the wage, the wage increases that we didn't
From
get
my
for 20
perspective as a
years.
worker, I agree. But the problem is for the Fed that it still supports inflation. In any case, I think we'll continue to talk about this is Bloomberg. Let's get over to Lisa Mateo right now. She's got your Bloomberg Company news. Lisa?
Thanks, Matt. Hyundai's union workers have voted to go on strike for the first time in 5 years. Now, the roughly 45,000 workers are looking to boost wages and raise the mandatory retirement age. The group is a branch of the Korean Metal Workers Union. Hyundai shares right now, they are down just a fraction. Meanwhile, striking writers, well, they aren't happy with their latest proposal. Bloomberg's Steve Podisk has more.
The Writers Guild of America says while the studios have made some concessions on artificial intelligence, they refuse to craft rules regarding how the writers' work could be used to teach AI programs to write scripts. And although the studios have said they would allow Guild staff members limited access to data on streaming viewership, individual writers won't be told how well their shows are doing or receive payment based on the information.
And the United Auto Workers have given union leaders permission to call a strike against the biggest U.S. car makers if they fail to agree on a new contract before September 15th. Amazon has its eyes set on popular sports network. Bloomberg's Kimberly Adams reports.
Lisa, the information reports Amazon has had early talks with Disney about working on the streaming version that it's developing for ESPN. The tech giant could reportedly offer the service through one of its streaming offerings, while also possibly taking a minority stake in the sports network. ESPN is considering charging between $20 and $35 a month for the new service.
Shares of Amazon right now, they are down just a fraction. And the Wall Street Journal reports BlackRock, King Street Capital, and Brigade Capital are among the Wall Street firms taking a part in lender talks about a possible Chapter 13 bankruptcy filing for WeWork. I'm Lisa Mateo. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Matt Miller here with Simone Foxman. Paul Sweeney is on assignment, and we're hosting, me and Simone, a special shortened edition of Bloomberg
Short
Markets.
and sweet, though.
Short and sweet because of the Jackson Hole special that we had. But by the way, don't forget, it wasn't just 8 to noon on Powell's speech. At 3 o'clock, Christine Lagarde is going to talk, and then at 4 o'clock, Tom Keene has an exclusive interview with the ECB president. So that's something.
And the ECB could be more interesting, frankly, than what we heard from Jay Powell.
Anything could be more interesting than Jay Powell telling us what we already knew, he thought. Let's get over to Nancy Lyons right now in Washington, D.C. She's got your world national news. Nancy?
Thanks, Matt. Former President Trump admits it was not a comfortable feeling to be booked and processed last night at the Fulton County Jail in Georgia. Bloomberg's Jody Schneider has more on what transpired as Trump surrendered.
He was there for approximately 20 minutes, was booked, had his name appear in the database, recording his height, his weight. I got an inmate number and a mugshot taken, which, of course, is historic. It's the first for a former president.
Bloomberg's Jody Schneider reporting from Washington. The list of people who remain unaccounted for after Maui's wildfire disaster is now down to 388, a significant decline from earlier estimates, over 1,000. Maui County Police Chief John Pelletier.
Once those names come out, it can and will cause pain for some folks that are affected by this. This is not an easy thing to do, but we want to make sure that we are doing everything we can possibly to make this investigation the most complete, thorough to date.
Chief Pelletier says search teams are still combing through the last unchecked buildings in Lahaina. Recent Canadian wildfire smoke is being blamed for a major jump in asthma-related trips to the emergency room. The CDC says researchers found ER visits were 17% higher than usual in areas where wildfire smoke triggered air quality alerts between April and August. New York and New Jersey saw the highest proportion of emergency room visits. The convicted serial killer known as BTK is now the prime suspect in 2 unsolved killings in Oklahoma and Missouri. Investigators this week searched a property near Wichita, Kansas that was owned by Dennis Rader, who was sentenced to 10 consecutive life terms in 2005. Rader, who's now 78, was convicted of killing 10 people in Kansas from the 70s to the 90s. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Matt and Simone.
Nancy, thanks very much for that. Now, I saw a story overnight that frankly shocked me as an aficionado of watches. Rolex is going to buy Bucherer in a deal that gives probably the most famous luxury watch brand a major presence in consumer sales for the first time. Now, Simone, this is huge because previously, although Rolex owns one flagship store in Geneva, it works with independent authorized dealers around the world to sell its watches, and it has a great relationship with those dealers. It's a very important relationship because people obviously try to fake Rolexes.
Well, does this compromise that relationship then?
That would be the concern. I think because it's Bucherer, which is also a family-owned business in Switzerland, just like Rolex, it kind of softens the blow. They wanted to get out of the business at Bucherer, and Rolex said, maybe it's better if we buy you than anyone else. But we're in a situation right now where when you want a Rolex, for the most part, you have to go to an authorized dealer if you want a new real Rolex, and be friends with the authorized dealer, hang out with the authorized dealer, get on a waiting list, because demand is so much higher than supply, and it'll take you a long time to get it. Now, if you want a used one, you're gonna have to pay up.
Yeah, I was just looking. You told me you were looking at a Rolex GMT Master 2, which apparently is more expensive when it's used than it's new.
Right, because if you buy a used one, you can get it today, right? I was looking at one in Wilson in Scarsdale yesterday. They had one for 16 grand. If you buy it new, it's like 10.7. But you have to wait a few months, maybe a few years. Anyway, very interesting story. For Simone Foxman, I'm Matt Miller. This is Bloomberg. Joe Matthew starts right now.
York. For our viewers worldwide, I'm Shonali Bassick, and Bloomberg Real Yield starts right now. Coming up, Powell leaves the door open for future rate hikes. The Fed chair also speaks to the neutral rate as R-star stands in flux. And with yields riding higher, the 5-year real yields climbed to the highest level since 2008. We're going to begin with the big issue, though, how investors are trading on the idea of higher for longer.
It is the Fed's job to bring inflation down to our 2% goal. 2% is and will remain our inflation target. The process still has a long way to go, even with the more favorable recent readings. GDP growth has come in above expectations. Readings on consumer spending have been especially robust. We expect this labor market rebalancing to continue. 2 months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. Getting inflation sustainably back down to 2% is expected to require a period of below-trend economic growth. The effects of monetary restraint should show through more fully over time. Sustained progress is needed, and restrictive monetary policy is called for. On a 12-month basis, core goods inflation remains well above its pre-pandemic level. We are attentive to signs that the economy may not be cooling as expected. Risk management considerations are critical. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive. We will proceed carefully as we decide whether to tighten further or instead to hold the policy rate constant. We will keep at it until the job is done.
Joining us now is PGIM's Michael Collins and Oaktree's Danielle Pauly. Thank you both for joining us on such a pivotal day for Fed Chair Powell. He really did leave the door open. You are seeing the front end of the curve up about to 505 on the 2-year. When you think about what was said today over in Jackson Hole, does it change anything about the way you're thinking about putting money in the bond market? Michael, let's start with you.
Yeah, I mean, the market's reaction has been pretty muted for sure. If anything, the markets continue to shift towards this view that funds rate, whether it goes up any more from here or not, but the important thing is how long is it going to remain with a 5 handle? And the markets are definitely shifting the curve, the intermediate part of the curve, closer and closer to that funds rate. That's been our view, that the curve was too inverted, the front end was too inverted. So the markets are starting to price in a higher funds rate for longer. And that's certainly a very possible scenario.
In conjunction with the higher funds rate for longer, he did hint at the uncertainty around R-star, probably not to the degree the market wanted. But Danielle, if you think about longer-term inflation and interest rate targets, do you think that there needs to be movement on that front?
Well, you know, Shonali, I wasn't surprised either by his comments. I think it confirmed to us a higher for longer environment that we've thought that we've been in for some time. Our chairman at Oaktree, Howard Marks, penned about this sea change in markets at the end of last year, really noting that persistently high inflation would require more restrictive monetary policy and thus shift this era of cheap money, which has fueled stocks and other equities, and really create, I think, an interesting and compelling opportunity for credit markets where rates are higher, and that does have implications, but it can benefit investors who can now get decent yield across the curve.
Danielle, where are you comfortable putting that money to work? Because on one hand, there are opportunities, but on the other hand, higher rates could signal more distress in terms of the more risky parts of the market.
No, that's absolutely right. Within our global credit portfolios, where we can be tactical and nimble and allocate across different investment categories, we have been favoring loans. Given their floating rate nature and the increase in base rates, the yield one can get is quite attractive. When diversifying across those asset classes, it's a double-digit yield. But you have to be a credit picker, and you have to avoid the landmines, because as you point out, income is a double-edged sword, and we are seeing stress in some borrowers who are having to make significantly higher interest payments. And we do expect that stress in the market will pick up, defaults will be higher, but it is such a large market that if we can avoid those landmines, there should be good opportunities.
Michael, there's another issue that had come up today too, and that is the divergence in rates, the divergence in monetary policy as you see it across the world. What does that mean for the value of a U.S. Treasury?
U.S. Treasuries look attractive to us by almost all measures, right? I mean, versus other bond markets, versus even real risk-free rates like SOFR, or other, risk-free rates that aren't affected by the huge amount of Treasury supply. So when you strip that out, you're getting paid a huge premium to actually own long-term Treasury notes in the U.S. versus other risk-free assets. So I think there's value there. Also, if you're managing a global bond portfolio, there's a lot of different currents, as you mentioned, happening across different central banks, different economies, different bond markets, different yield curve shapes. So there are ample opportunities to take advantage of that. For example, we might be, short Japanese government bonds, thinking that 10-year JGB yield of 65 basis points, might have some upward pressure given these higher rates around the world, and maybe, long other interest rates.
Well, speaking of other interest rates around the world, there's a lot of conversation this week about the pricing when it comes to European bond markets, potentially overvaluation or overbought gilts, overbought euro even. Do you have a view on whether that is the case or not?
Yeah, I think interest rates in the developed world generally look really high. You're seeing growth. Obviously, in China, really start to crumble. That will affect Europe, and in fact, it is affecting Europe. There tends to be a much more immediate impact on Europe vis-a-vis the U.S., where we tend to be a little more internally focused. So if the view is that growth in a lot of places are going to continue to lag and come down, whether or not inflation really follows. I think there are opportunities in some of those other bond markets where their central banks, whether it's the European Central Bank or the Bank of England, are probably looking to raise rates, one or two more times.
Danielle, when you think about what was said today, everything today that's happening in Jackson Hole, the reality is there's a ton of economic data ahead. What are you looking at in particular, and how are you factoring any potential of future inflation shocks?
We are focused still on inflation. I think we've seen commodity prices come down rapidly, but they could surprise to the upside in the future. We're also focused on shelter, given what a large percentage of core that makes up. Generally, outside of inflation, we're watching the labor market. It's remained incredibly tight with significant wage growth, and we do think that needs to cool off, and we will be getting increasing data. And today, Powell did really express that his views and monetary policy will continue to be data dependent, but that there will be generally tighter financial conditions in the market, which then has implications, as Mike was saying, for all types of different credit asset classes. We've talked a lot about the public markets, but also the private credit markets in particular. Tighter financial conditions, less lending from banks. This should create opportunity for credit investors.
Well, how much competition does that set up for credit investors? If you look to the private markets, Danielle, you have asset managers pitching anywhere from 8% to 12% returns. When you look to private markets, they give you that trade-off in liquidity. Do you buy that story over what is publicly traded, or do you find that the public markets offer compelling opportunities too?
I think the public markets offer compelling opportunities too, and if you can have a blend of both in your portfolio, all the better. I think that you've seen issuance generally down in the public markets, and some of that is being absorbed by the private markets, as there are managers that don't have legacy portfolio issues, can write and speak for large checks, and really step in where the banks have pulled back. And that's not just the case for corporate loans as well. Real estate in particular, with commercial lending, banks have provided over 50% of the financing, and there's a lot of maturities coming due over the next years that will need to be refinanced. So we do see really attractive private opportunities.
Now, I want to point to a conversation earlier today with Steve Whiting of Citigroup, who weighed in on the bond moves in short positioning in particular. Take a listen.
One of the things you can see right now are record high levels of short positions in futures and 10-year notes and 2-year notes. It's a lot like where we were in the equity market at the beginning of the year. We see a lot of shorting of bonds right now.
Michael, I want you to weigh in here on some of the futures positioning here and how investors are set up for the future about potential future sell-offs. Do you think that is the correct direction of travel?
You know, I think that's a great contrarian indicator, Sonali. You know, the positioning tends to go from student body left to student body right. I mean, just a few months ago, the markets were pricing in a pretty high probability of recession, and everybody was long duration. At that time, in our strategies, we actually got a little bit short, thinking, wow, there are way too many Fed rate cuts priced in way too soon. And as the curve has backed up a lot, and now we're moving back toward what is likely the higher end of the range on interest rates, everybody's now pricing in this soft landing scenario, this really benign scenario, both in rates and in credit. Right, so I think the idea is to fade both of those, to go the other way, start adding duration here. We've certainly been covering our short duration position, much more constructive on rates at these levels, and to Danielle's point, you know, a little more nervous on credit given the rally in spreads.
Danielle, I'd love for you to double down on some of the nervousness, because if there are sectors or types of credit you're avoiding, what would you sell or avoid touching right now?
Well, you know, it's hard to paint things with a broad brushstroke. I think what you need to do is you need to look at some of the capital structures that were put in place back in 2018 through 2021, where in particular private equity sponsors weren't considering this drastic rise in base rates that we've seen and having to refinance into this type of a market. And so some of those companies and those vintages are going to be the most vulnerable across all different types of sectors. Generally, what we have seen this earnings period is some resilience in the consumer. Consumer sectors are doing better than many would have thought, and there may be reasons for that, like excess savings not having run out, and many of these companies having time to prepare their businesses for a recessionary environment. So as always, you know, taking an individual credit approach we think is better than looking kind of top down across sectors.
Danielle, if you think about this idea of bonds versus loans at this point, given the attractiveness of floating rate, do you stick to that trade or do you start to rotate a bit now?
You know, I love the yield pickup that loans provide today, but I am mindful looking top down at the two markets that the loan quality is a lesser quality market. I mean, the high yield market is actually has a double B percentage that's at a 10-year high. And if you think about what we went through during the COVID period, where you had defaults from investment grade, as well as, you know, some of the worst CCC cohort defaulting from the market, it's just a higher quality market, and one which many used kind of the open window to extend their liquidity. Whereas in loan land, now that those interest payments are coming up and ratings are lower, it's a generally lower quality market. You saw loan-only capital structures put in place in some of those vintages that I mentioned. But if you can pick the right loans, it is a $1.3 trillion market. And if there are increases in defaults, that still leaves so much of the market that will repay that high income that we don't think it can be ignored in actively managed portfolios today.
Recalibrating our bets across the board on a big day. Michael Collins and Danielle Polly, thank you both so much for your time. Up next, we have the auction block. We're going to focus on the banks as Charles Schwab sells fresh debt after revealing plans to cut costs. This is Real Yield on Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, is all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
I'm Shonali Bassick, and this is Bloomberg's Real Yield. It's time now for the auction block. It was a quiet week here in the United States, but it was quite active in Europe, and the summer drought has come to an end. Financials helped to drive sales in the primary market past 30 billion euros. The one notable sale in the U.S. was tied to a bank. Charles Schwab sold $2.3 billion of senior unsecured notes in a two-part deal. The move comes the same week it announced job cuts and office closures. And sticking with the financials, that sector around the globe has sold $2 trillion worth of bonds in a record time this year. Sales of euro-denominated securities are up more than 50% from the same period last year, making up the largest share globally. Now we're going to get back to Powell because Mohamed El-Erian of Bloomberg Opinion and Queen's College Cambridge weighed in on the Fed's path forward.
If the right inflation target is 2% and they want to get there in a credible period of time, then we are not sufficiently restrictive. If the right inflation target, as you've heard many people say, including Adam Posen today, is above 2%, given all the structural changes, and the way we're going to get there is not by announcing the new target, but by following a shadow target, and then once we see it stable, adopting it. I think that's the most likely outcome, by the way. Then we are sufficiently restrictive.
Brian Smedley of Sinosure joins us now. Brian, if you take a look at what had been said today by Fed Chair Powell, was there anything surprising? He had left the door open for future interest rate hikes. You still have a market expecting cuts into next year.
Yeah, that's right. I don't think Chair Powell really broke any new ground today. He echoed a lot of the themes that he emphasized in the press conference and that were, again, in the FOMC minutes from the July meeting. But I think he really put a marker down to indicate that the Fed is not considering revising up its inflation target, as Mohamed spoke about. They're focused on 2%. They clearly feel like the job is not done. There's more work to do to loosen up the labor market for the Fed to feel confident that inflation can be brought back down to 2% and sustained at that level going forward.
Well, let's talk more about that target, because there's been a lot of conversation this week about R-star, and he voiced the uncertainty around it. However, to your point, he did not go so far as to say that it should be revised. Should it be?
Yeah, well, I think long-term R-star probably is higher than the 0.5% that's indicated in the longer run dot in the SEP. So I think that probably is too low. That estimate came down over the course of the post-GFC period and has stayed at 2.5% in nominal terms, half a percentage point in real terms. I think that's the evidence suggests that it has risen. As Chair Powell indicated, the labor market is having a greater impact on inflation today, a tight labor market, than we saw before the pandemic, and that suggests that the Fed's longer-run unemployment rate estimate may be too low, and that our star may also be too low.
How much variability does that mean for longer-term interest rates, and what does this mean about the more permanent repricing of rates?
Yeah, well, it certainly speaks to the higher for longer theme that your previous guests were discussing, and I think it suggests that the Fed is going to have they're going to have a long waiting period when they finally do finish hiking to wait and see the data evolve and try to get more clarity on what R-star is. But one of the challenges that the Fed has had is that the forward guidance on the longer run neutral rate, I would suggest, has been working at cross purposes with what they're trying to do on short-term interest rates on the balance sheet, because it's contributed to a significant inversion of the yield curve, because their guidance is contributing to that anchoring tempering of long-term inflation expectations.
Yeah, there's a lot of conversation around that lagged effect and the tightening that we might still see, but explain what the balance sheet reduction means on top of the interest rate hikes itself.
Sure. Well, without a doubt, the Fed's addition of duration supply and convexity through the runoff of the portfolio is contributing to the rise in long-term rates. We just heard from the Treasury at the beginning of August in the refunding statement that they are beginning the process of several quarters of increasing coupon supply. That's going to add to what the Fed is doing, and on top of that, we've got a significant budget deficit. So, without a doubt, the market is going to be struggling to digest supply, which is why I think from a yield curve positioning standpoint, we're going to continue to seesaw between, bear flattening episodes like we've seen today and steepening episodes like we saw earlier in the month as the market has to digest more supply.
I want to bring out even another view brought forward by PIMCO's Tiffany Wilding this week, because she wrote in a note to clients this week that recent data would suggest the consumer and the economy could remain surprisingly resilient in the face of higher interest rates, to your point on that labor market. But it means that it's not unthinkable to envision the Fed not only staying on hold, but announcing a further rate hike next year. Do you buy that view?
I think it's possible. I think there's a good chance that in the first quarter we might, the Fed might decide that more work needs to be done. That wouldn't be my base case at this point. I think it's most likely that they deliver one, maybe two more hikes before the end of this year. But I think it's too early to say what the first quarter looks like. My sense is that as we get through the first quarter of next year, we're more likely to see the labor market data rolling over, and that's probably going to be a place where the Fed decides to stand pat and watch some softening in the labor market.
There was certainly a conversation this week about the places you have seen the interest rate issues really take hold, the real estate sector, the consumer, not quite yet. Employment, at what point do you see it soften materially?
Yeah, probably not in the next few months, but I do think as we get into 2024, there's a good chance that the unemployment rate is starting to move up. Looking at the Fed's projections from the June meeting, which is a little bit dated now, but they had been anticipating the unemployment rate to rise from 3.5% to 4% by the end of this year and 4.5% by the end of next year. So it's less likely, I think, that 4% is attained in December. But if you take them at face value, and I think it's a reasonable base case, we're likely to see recessionary conditions next year. That's really the only way that you get a percentage point rise in unemployment.
We only have about a minute left here. Do you think that the recession comes to be that soft landing that the Fed is hoping for?
Well, look, Chair Powell said again today that they're looking to see some softening in labor market conditions and a little bit higher unemployment rate. The historical evidence suggests that we've never seen a rise in the unemployment rate of a 0.5 percentage point or more without a recession ensuing. And in every post-war economic cycle, the rise in the unemployment rate has always been at least 2 percentage points. So it's very hard to see. It would essentially be unprecedented for the Fed to nudge up the unemployment rate a little bit, run the economy a little bit below potential for a sustained period of time. A couple of years is what their forecasts suggest, and that not end in a recession. So I think a soft landing is looking unlikely.
Soft landing, but messy couple of years. We thank you so much, Brian Smedley of Cynosure. New job, by the way. Congrats. Still ahead, final spread. The week ahead, it's Jobs Day in America next week. And this is Real Yield on Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how to memorize things. That makes you, and that's what your brain figures out while you're sleeping.
I'm Shonali Bassick, and this is Bloomberg's Real Yields. It's time now for the final spread. The week ahead, coming up, JOLTS data coming out on Tuesday ahead of a reading of second quarter GDP on Wednesday. Thursday brings another round of jobless claims, plus the PCE deflator, and we will round out the week on Friday with the U.S. payrolls report, the big day ahead. Let's talk a little bit more about what that would look like. Non-farm payrolls expected to come in at 165,000. Unemployment rate standing steady at 3.5%. The participation rate also steady at 62.6%. And that average hourly earnings month over month expected to cool slightly at 3 basis points of 1% higher compared with 4 basis points or 0.4% the month earlier. And from New York, that does it for me. It's same time, same place next week. This was Bloomberg's Real Yield, and this is Bloomberg.
Economic pain may turn into emerging markets gain. Investors say they plan to allocate more funds to emerging markets over the next year. That's according to the latest Bloomberg survey of professional and retail investors. More than 60% of respondents are betting emerging markets will either push higher or outperform the developed markets if the U.S. economy tips into recession. This would mark a significant change in leadership that's been in place for more than a decade, in which U.S. stocks have returned more than 700% since March 2009, dominating the rest of the world. Within EM, market watchers rank stocks as the best investment, followed by a tie between debt in local currencies and U.S. dollars. Lower valuations is a big draw. In equities, the MSCI Emerging Market Index trades at 12.5 times estimated 2023 earnings. By contrast, the S&P 500 has a multiple of more than 18.5. External factors may end up proving to be bigger influences on emerging markets than domestic politics. The dollar's weakening trend means companies in emerging markets should have more room for growth, and countries that did not prop up their economies with stimulus during the pandemic may be better positioned to return to a growth rate that's sustainable. Looking out over the next 2 years, respondents overwhelmingly made Southeast Asia their top pick, beating out Latin America and Eastern Europe by a wide margin.
Welcome to Bloomberg Markets. I'm Amber Canwar.
And I'm Alex Steele. Let's get a quick check-in here on the markets. I should point out, everyone, volume's really light. Nonetheless, the S&P's eking out a gain here, up 0.2%. It does feel like you could find a hawk, you could find a dove within Jay Powell's speech. We'll get to that in just a moment. A couple things to look at. One is the dollar index. That's up about 0.1%. The dollar yen's at its highest level that we've seen so far this year at one point. So just keep that in mind as we go through the session. The best performing sector in the S&P is energy. Why? I don't really know. There doesn't seem to be a lot of an explanation because of that. But the worst performing stock is Dollar Tree in the within the NASDAQ, for example. So just take it with a grain of salt when you see what's happening with tech. 10-year yield pretty much going nowhere. A little touch of buying coming in the long end. But I did want to take a look, Amber, at the 2-year, because this is where you really get the push and pull from the doves and the hawks when it comes to what Jay Powell said. Right there around 10 o'clock, you see the buying come in and yields move lower. As he keeps talking and as we digest the speech, you see the sell-off continue and yields pushing higher, at one point breaching that 5% level, the highest level since 2008. Amber.
Well, some of this could be Fed related, but there are some stock specifics out there. Alex, Boeing, for example, is now in positive territory. Reports are that they're going to start resuming selling their 737 MAX jets in China. They haven't done that in 4 years since 2 jets crashed. So this is a pretty significant milestone for Boeing, and you're seeing the shares react. BlackBerry is surging. Bloomberg is reporting that private equity player Veritas is in early discussions to buy the whole company, though they are early and no price has been disclosed. And it's interesting to see NVIDIA blowout quarter. The stock fell flat yesterday, and now it's just outright down. Is the AI craze waning? That's the thought over at Morgan Stanley. That's what Mike Wilson thinks. And in retail land, both the Gap and Nordstrom offering a picture of disappointment when it comes to sales. But shares of the Gap are rallying as investors are giving the new CEO who came from Mattel perhaps the benefit of a doubt that he might be the person to turn things around. He's only been on the job for 3 days, but certainly there's a big task ahead of him.
All right, so let's go right to what Fed Chair Jay Powell said. Seemingly hawkish, but you could find some dovishness and maybe some neutral as well. Here's what he had to say earlier in Jackson Hole.
We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective. Based on this assessment, we will proceed carefully as we decide whether to tighten further or instead to hold the policy rate constant and await further data.
Joining us now from Jackson Hole is Bloomberg Odd Lots host Joe Weisenthal. Joe, it seems like the reaction here is depending on where you started. If you were a hawk, you see some hawkish notes. If you were a dove, you see some dovish notes.
You really, I love the way, I love that description. A little bit of dovishness, a little bit of hawkishness, a little bit of neutral. But I think that's like totally spot on. And I guess if your goal is to maintain maximum optionality, if your goal is to say we're being data dependent in a way that doesn't sound totally cliche and say data dependent, why would you come all the way to Jackson Hole to say you're data dependent? That's really what you want to go for. And you know, prior to the speech, there were all these discussions about like, was it going to be sort of academic? Are we going to talk about R-stars? They're going to be productivity. And there's a little bit of that, but it's basically a sort of straightforward acknowledgement that there's been improvement on inflation. There are still upside risks to inflation. The problem is not totally solved yet, and that there's a good chance that there's more work to be done, which I think is probably like a good way to give a good speech without making a massive ripple.
Yeah, and you can definitely see that in the market as we just kind of price the status quo, Joe. I'm curious, you know, Jay Powell had some help, right? The PMIs rolled over, but they weren't terrible, right? The data's still strong. I gotta say, Christine Lagarde does not have the same kind of help.
Right. You know, I really liked the last line, because again, going back to the stars metaphor, you know, setting aside long-term concepts of, well, what is neutral and what is like sort of normal, et cetera. I love that line. It's like, it's cloudy skies. And I think that you put it really well there. Like, you could tell so many different stories about this economy, and that's what it comes back to. Like, again, you know, and I think we even talked about this yesterday. Like, you could tell a negative story about things that are rolling over. Interest rates shooting higher and the home builders slumping. saying again, there are negative stories, there's also positive stories. And so I think like that sort of like cloudy skies, like it's pretty confusing, right? Like I don't think anyone has like a great handle on this cycle. And if you say, yeah, it's kind of cloudy out, so we want to take our time and see how things develop before November, before December, et cetera, then that's sort of like where the Fed is at right now.
One thing he was super definitive on was the inflation target is 2%.
Yes.
And that was very clear. There was no room for interpretation.
No, totally. And it's interesting because, of course, this conversation about, well, should the inflation target be raised in a formal manner? You know, there was a recent column by Jason Furman in which he said maybe 3% would be more inflation. Powell was pretty definitive on that there is no plans to do that. However, you know, I do think in a way, like, look, we have had inflation very high for the last 2 years. And while the Fed has obviously endeavored to bring it down, it didn't completely slam the brakes on the economy. So to some extent, the Fed has already been making the decision, one could argue, that it's worth that some level of toleration, or at least for some period of time, it's worth tolerating some period of higher inflation if it means robust labor markets. And I really think actually that's the way to think about it even today, which is like, we have this pretty good labor market in the U.S. 3.5% unemployment, high levels of employment to high levels of prime age employment to population ratio, things like that. And so the question is like, how much do we want to preserve that, or how much are we willing to sacrifice some of these gains we've made in the labor market to get back to 2%? And while the Fed isn't going to come out and say, oh, our new target is 3%, it's also not saying we got to be back to 2% tomorrow or next month, which is why, you know, they're still not jacking up rates massively.
Exactly. Again, the tightrope. Joe, you need shades. Go get some sunglasses. Joe, thanks a lot. Really appreciate it.
I do need to get some sunglasses.
Joe Weisenthal joining us. Really great stuff. And check out Joe's latest episode of Odd Lots with Tracy Alloway on the Terminal, and anywhere you get your podcast, definitely worth a listen. Let's discuss now with State Street Chief Economist Simona Mokuda. Simona, good to get your perspective. We talk a lot about what the Fed's going to make of R-star. Has the market decided what R-star is?
No, I don't think anybody has decided, the Fed or markets. Everybody is just wondering, and I think that is really the place we are. And I have to say, as I was reading through Chair Powell's speech, I said to myself, this feels very much like a conversation we had internally here with some of our investment colleagues just the other day. There is universal consensus that where we are today is not an equilibrium position, that the rates are restrictive, but when you get into the details of how restrictive exactly are we, that's where there is a difference of opinion. And that's exactly what Chair Powell basically said today as well. There's a lot of uncertainty. I think it's a fool's errand to try to definitively answer that question today. This is a process. We are getting to that new neutral, experientially. We see what the economy, what the data does, and that's how we'll draw conclusions about where that longer-term new equilibrium, if it's truly new, settles.
Well, then we're just really debating decimal points here around that, which is in stark contrast to how we started the year, where the Fed and investors were in totally different places with respect to rate expectations. Is it fair to say that, you might disagree with some nuances or basis points here and there, but the Fed has done a good job of bringing the market on side with its view?
I think in the short term, yes. The idea that, there is a surprising degree of resilience in the economy, and that this perhaps could imply that rates need to be higher or higher for longer than the market initially estimated. But I think this is you get to the tricky part of but why have we seen this kind of resilience? And perhaps as economists and maybe markets in general, we haven't given enough credence to the positive impact of disinflation that has been already accomplished over the last year, right? We came from 9% inflation to 3%. Real disposable income is growing at almost 5% year on year. A year ago, it was contracting 4%. So the question to me is then, this resilience that we've seen recently, especially in consumer spending, can that be extrapolated for the next 6 and 9 months? And I think that's a little more questionable now.
Simona, I was mentioning this earlier. Jay Powell has help with data that's holding up, even if it's rolling over. Europe is not in that place. The PMIs were really bad this week. Christine Lagarde speaks in about an hour and a half. What tightrope do you expect her to have to walk? Because if you take a look at the market reaction, higher bond yields in Europe, that is the trade of the day.
Yeah, I think the challenge was always more difficult for Europe, not only because of, the inflation shock has been a little more acute, more externally driven, a little, more difficult to counteract. But also because of the nature of the Eurozone, right? You're trying to set policy for different realities in different countries. So I think from my point of view, the question is very similar to the US. You are clearly restrictive territory. The Eurozone is, policy rates are far into restrictive territory. And then the trade-off question is, okay, how quickly do we need to get back to the inflation target? There is clear evidence that this inflation is accelerating, progressing in the Eurozone as well. And with the growth data coming in weaker, perhaps, I would argue that maybe it speaks more towards a caution approach from the ECB as well.
So do they pause in September?
I think they should pause and reassess. It's true, like every central banker would wish the inflation target, was achieved very quickly rather than over a period of time. But the truth is that getting, inflation under control is a little bit like a weight loss process. You do too drastic actions in the near term and you have bad side effects. The process is consistency, right? And ensuring the downtrend, extending the downtrend and entrenching it. And I think Europe is achieving that. Ultimately, it's not a guarantee what they do, but I think the ECB, just as the Fed, has actually done enough already.
All right, we got to leave it there. Simona Makuta, thank you so much joining us from State Street. And Alex mentioned Christine Lagarde. There will be an exclusive interview with her by Tom Keene on Bloomberg at 4 p.m. New York time. You won't want to miss that. Coming up, Zillow is now offering a 1% down payment for new home buyers. We'll discuss it with the company's chief economist next. This is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Today, European Central Bank President Christine Lagarde sits down with Bloomberg's Tom Keene for a conversation on the political economics of Europe and the permanent shifts in the global economy. Tune in for the exclusive interview live at 4 p.m. Eastern from Jackson Hole, only on Bloomberg.
This is Bloomberg Markets. I'm Amber Canmore with Alex Steele. Warner Brothers Discovery is among the S&P 500's worst performers in today's session. The company is reportedly delaying the release of the Dune movie sequel as the Hollywood strikes impact production timelines. It's also launching a CNN streaming channel on its Max platform next month. Let's discuss here with Bloomberg's Jerry Smith. Jerry, what's the significance of this?
This is a big deal for CNN. They've had some slow starts in the streaming world. They had a CNN Plus product that was scrapped after about a month. So now CNN's really starting to get into the streaming game in a meaningful way.
Jerry, how is this? First of all, actually, is the stock movement today a reflection of the CNN Max situation or a reflection of movies getting pushed out because of the writer's strike?
I think it's more of the latter. I think that CNN, having a bigger presence on the Max streaming service is not something that's going to move the needle too much for Warner Brothers Discovery stock. But I think there is, and obviously with the Hollywood strikes going on, the timing of movie releases is something that investors are very interested in.
Is the reaction because we thought that the strike would be sort of wrapped up or at the very least winding down by now and the casualties wouldn't be, to this degree?
Yeah, I mean, I think that the strike's been dragging on for quite a while, and it's very complicated. And as far as the movie releases go, I mean, this is something where, depending on how long the strike goes, we could start to see movies getting pushed back farther and farther into 2024, and that's obviously going to have an impact on all the big media companies.
I'm probably the only person who is bummed about Dune 2 being released later. But putting that aside, if we go to the CNN Max situation, how is CNN Max now different than CNN Plus?
Yeah, it's different. CNN Plus was a standalone streaming service, and that was something that was built under previous ownership. So when AT&T did its deal with Discovery, the new owners came in and decided that they didn't want to move forward with CNN Plus. So now they have this Max streaming service. This is really, the whole company is making a big bet on streaming with this Max service. Used to be called HBO Max, and CNN is going to be a part of that. And it was, it's a little bit tricky. They had to make sure that they didn't upset their cable distributors who pay money to carry CNN. So they're going to rely a lot on international content, and they're going to have some original programming that you can't get on your cable service.
I guess it would also allow you to reach out to those cord cutters, right? That if you've cut your cable, you don't get CNN on your television anymore. This is kind of another way to bring them back in.
That's right. I mean, we've seen a huge number, tens of millions of subscribers that have fled cable TV in the last several years. So all these cable networks, including CNN, are trying to find a way to reach these generally younger consumers who have abandoned cable TV.
So how are they going to do that? I was reading in the article that maybe if you're watching Max, there's like a little button that says like breaking news, go to CNN, or something that will retrain your brain on how to find breaking news, which I actually found quite interesting.
Yeah, I mean, it's going to be something within Max, and I'm sure that there's going to be various ways where perhaps you're on your phone and you get a push alert saying, hey, there's breaking news, go to Max. It's really going to be a challenge trying to train people who are accustomed to when big breaking news events, they go to the CNN cable channel, or they, obviously this is competing with social media. There's a lot of different, competition for breaking news, and, CNN's a little bit late to the game here in streaming. Some of the other big news companies, NBC Universal, CBS, ABC, they've had streaming services for quite a while, so they're playing a little catch up here.
Yeah, it's gonna be really interesting. I cut the cord, so it's like I always figure out where am I going? Where am I going for the news? All right, Jerry, thanks a lot. Jerry Smith, thanks very much. Coming up, I love this story. Zillow's new down payment incentive has 1%. This is Bloomberg.
Replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Markets. I'm Amber Canmore with Alex Steele. We're tracking Zillow right now. This comes after the company said that it will offer mortgages with just a 1% down payment as it tries to attract homebuyers facing the most unaffordable market in almost 4 decades. Zillow hopes it will grow its customer base with this new offering as mortgage rates hit a 22-year high. And Alex, as a Canadian, this story sort of blows my mind. You can't get a house with less than 5% down, and anything under 20% has to be insured.
Yeah, and even it blew my mind here too. So let's get to it with Zillow's chief economist, Skylar Olson. She joins us now on the phone. Skylar, I gotta be honest, when I see the headline, I get really worried about, Countrywide and what we saw there. Why did you guys decide to do this? Walk me through it.
Yeah. Well, let's talk about the program a little bit from Zillow Home Loans. So it is 1% down from the perspective of very qualified borrowers who are eligible in Phoenix. But ultimately, the loan needs to get up to 3% down. So Zillow Home Loans is making that 2% grant to bring the borrower up that 3% total. Now, 3% down, this borrower still has to qualify for a mortgage payment at today's mortgage rates, right? So this is a very eligible borrower, generally a high credit score. They have the income on the regular to make that monthly payment. What they don't have is that built up savings to make that down payment to get in the door.
And is this opportunity coming as, the more traditional avenues of finance get a little bit more conservative, and as we see sort of the shortage in demand, that customers are sort of craving flexibility? How can I get together enough to buy a home? That's still the dream.
I think the reality is, too, is that there are a lot of people out there, say massive amounts of millennials and Gen Z, and they have very similar aspirations to previous decades. And, they're trying to figure out how to make their way forward. And when you think about, a program like this, this is for the person who doesn't have that generational wealth and savings to get their access in the door, right? But they are someone who has been able to earn and build that career over time, right? And so this is a product that's kind of developed more for them, but at the end of the day, it's still a 30-year fixed rate loan that can offer that person financial stability.
Well, what's your basis? Like, if you're looking at the 30-year mortgage rate, which we see on air, which is 7.57, what's the loan that you're offering? What's the basis?
Oh, yeah. Well, I can't speak to those specifics on kind of the business side of that one for the Zillow home loans. I will say, in terms of the set of people, when you're thinking about who is eligible for this one, right, it's within different price points and other kind of realms of eligibility. So here, this is a fairly qualified borrower that can generally get among lower rates.
Really interesting, Skylar. This story is not over. You definitely got to come back. Skylar Olson of Zillow. What I find interesting, Amber, is that there's definitely a bifurcated market. You have the new home sales market that's still jamming forward, and you have existing home sales that are really constrained by supply. And if this loan goes nationwide, I have to wonder what that does to the bifurcated market. Does it make it tighter in certain areas instead of looser?
It might, and I've heard growing calls about, well, how much farther can this trend take, an area like the home builders, which is already trading close to those record highs. And it would, I don't think anybody would have guessed that at the beginning of a rate hiking cycle, we would start to see that towards the end of it.
Yeah, exactly. I think it's a really good point. Okay, in the markets, though, we're still looking at mixed equities here, but relatively higher, but the volume is quite light. I just want to point out that NVIDIA is the worst performing stock within the S&P, whereas Hasbro, after an upgrade, is the best performing stock. It's hard to know if there's a real signal, though, within that market, or just positioning. It is a Friday. It's a summer Friday in August. All right, for Amber Kenwar, I'm Alex Steele. Have a good weekend, everybody. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Slice through the noise. Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Happy Friday, live from Studio 2 at Bloomberg headquarters in New York. I'm Scarlett Fu.
And I'm Shonali Bassick. We're kicking you off to the closing bell here in the United States. Big day at Jackson Hole. But we are looking at an S&P 500 that is squeaking out a gain today, up 0.3%. NASDAQ 100 also up just over 0.1%. The two-year yield, is at 5.05. Interesting moves here, about a 3 basis point hike off the heels of that speech over at Jackson Hole by Fed Chair Powell. The 10-year yield about stable, 4.23, Scarlett.
423, and of course, amidst all of that, we are on IPO watch because Instacart is expected to go publicly file its plans for an initial public offering with the SEC. That paperwork will include new details of its finances and operations. And according to Bloomberg reporting, Instacart is planning a traditional listing on the NASDAQ as early as September. The largest U.S. online grocery delivery company would follow chipmaker Arm in making plans to go public and give the sluggish IPO market a little bit of momentum. Now, a summer of strikes may roll into the fall as the United Auto Workers Union takes a step closer to calling a strike. 97% of the members voted to authorize a potential work stoppage against the biggest automakers if negotiations fail to result in a new 4-year contract before September 15th. Now, the car makers estimate that conceding to all of the union's demands would cost each company more than $80 billion each year. So as we close out this week, it's really been two events, Shonali, dominating the market's attention. NVIDIA's earnings and whether it justifies the AI craze. The answer is yes, but mainly for NVIDIA and maybe less so for others, at least for now. And of course, Fed Chair Jay Powell's speech this morning. So Shonali, where does that leave us?
It leaves us with a short end that is moving higher and a long end that is not moving at the same pace anymore. We're looking at the front end rise faster and that yield curve finally starting to flatten just a little bit here. And that 10-year, keep an eye on it because really it's that volatility in the longer end of the curve that investors have had their eye on. You take the Bill Gross kind of point of view here with the expectation that that starts to taper at 450. Today it's about 423 or so with a massive move, as we've been talking about, that has been made in the front end through the week, not just today. Today is only about a 3 basis point move there, Scarlett, but we'll keep an eye on it with more economic data next week too.
We absolutely will, and there's a lot of data points for everyone to consider now that Jay Powell has spoken at Jackson Hole. He pretty much stuck to the script in saying that the Federal Reserve is prepared to raise interest rates further if needed and intends to keep borrowing costs where they are, pretty high, pretty elevated, until the Fed is clearly on trend to keep inflation at the 2% target. Inflation has to stay at that level. We are still a long ways off from that. So a couple of comments there from Jay Powell that sounded somewhat hawkish, Shonali, but for the most part is what everyone expected.
It was, and you saw that move in the 5-year real yields. I think that was pretty stunning, most since 2008. Finally starting to catch up with reality. There are still expectations for a rate hike priced into the market next year, and that is something now up for debate, isn't it?
There's a lot that's up for debate. So let's go now to Jackson Hole, Wyoming, where our very own Michael McKee is currently standing by with the Chicago Fed President, Austin Goolsbee.
Well, thank you very much. We'd like to welcome you to Jackson Hole, and we'd like to welcome Austin Goolsbee to our studios here. Thank you very much for coming out on this gorgeous day here. I know lunch is coming up. You'll want to get to that. But we first have to ask you about Jay Powell's speech. There's been some feeling it was generally hawkish. What's your take on it as somebody he's going to try to persuade one way or another?
I don't totally know. I'm not to try to get in Jay's head.
I thought he rightfully was respectful on this is not a mission accomplished announcement. We've seen progress for a few months on price inflation, which is what we need to see, highlighting the kind of the three areas of goods, services, and housing. But that the job's not done. You know, the inflation rate is still higher than where we want it to be. And so the implication being all this discussion about, oh, maybe we should change the target and declare victory, that you can't do that until you've hit the target. You can't just say, we didn't want it anyway.
Well, what's it going to take to hit the target? He raised the idea that the economy is growing faster than you all had expected, and therefore that could be inflationary, and you might have to take action against it.
Yeah, well, look, we might. I've been talking about what I call the golden path, which is not normally feasible. It's not normally an option for central banks. That if you could get inflation down without a big recession, that'd be a major triumph for the Fed or anybody. It'd be virtually without precedent. But we're part of the way down that road, and we've been getting good news. We just have to keep getting good news. I mean, I think the argument that there's a stable relationship, let's call it, between economic growth or the unemployment rate and the rate of inflation, that's a model. That's a theory, and that theory hasn't done very well. It wasn't doing that well even before the pandemic, and it hasn't done that well coming out of the pandemic. So I guess I would just have a note of caution. Let's not over-index on numbers like wage growth as an indicator of inflation, because historically that has tended not to be a leading indicator for price inflation. And let's not over-index on a quarterly growth rate, as that means what's about to happen to inflation, because we've been several months now where those two haven't been that correlated.
Well, the implication of a faster growth rate is that demand is going to be greater than supply, which will be inflationary. Do you see the economy in that situation?
Well, now hold on. It could mean that. That could be one interpretation. But the other important interpretation, and some of the researchers that are presenting their papers here at the conference are highlighting, you can't forget about what's happening on the supply side. We went through this period where some significant chunk of the inflation that we saw that was unexpected came from the supply side deteriorating into interference, supply chain interruptions, et cetera. So if you fix the supply chain interruptions, you could get a drop in inflation without a decrease in output. Or you could have GDP growth that was faster than even trend without it being inflationary. So that's part of the confusing cloud that we're trying to see through. So I do think we should keep both sides of it in mind.
One of the things that was inflationary, as you point out, it follows inflation, but that's wages. And now we're getting into the contract pattern bargaining season, especially with auto workers. You have a big auto workers district. Are you concerned, by the way, the United Auto Workers took their official strike vote today. You probably know that they could go on strike before September 15th. Do you worry about that?
I definitely worry about that. It seems like every 3 to 4 years in the 7th district, where Chicago's the head, that's the most auto-intensive of all the Fed districts. Every 3 or 4 years, we think about this issue. If there was a big strike that affected multiple auto manufacturers and lasted for a long time, my fear is that would have a pretty material impact on the manufacturing economy. So that's where my head is. About wages, as I highlight, as we've just described, I think wages move slower than prices. When things happen in the economy, prices go up first, then wages go up. As prices come down, then wages will come down. If your decision rule were, I'm going to just keep slamming on the brakes until I finally see wages get down to growth of 2% a year, consistent with 2% a year, you will almost certainly overshoot, because the prices will have that will have happened in prices before wages. So I do think we should keep that in mind as we're going into contract season. Much of what we're seeing on wages now are reflecting what happened with prices 6 months ago.
Well, if we get big increases, do you think the auto companies and then all of the parts suppliers, are we going to see a trickle up of higher prices to make up for it?
Well, I think that's describing a wage price spiral. That it's
I'm
like,
trying
hey,
not to use
if,
that
the
word
wages, if
necessarily,
the wages went
could,
up,
yeah.
would that lead to higher prices? Rather than talk about that in theory, I would like to think about that in the data. Historically, and in this current period, we're not seeing really any evidence of wage price spiral at this point. What we're seeing in wage growth is largely what we saw in price growth from 6 months ago. They're a lagging indicator, not a leading indicator. So that's why I've tried to highlight, let's look at the new months of price inflation data, especially goods and housing, which in the short run, those are the things that got to start coming down notably. They did for a couple of months, and that needs to continue for the Fed to feel like it's on the golden path.
You mentioned housing. It's an unusual situation because we went into this higher inflation period with so many people having very low mortgages that the housing market is essentially frozen now. Have you sort of destroyed the housing market for a generation?
I hope not. I mean, I think you're right. It's unusual. And as interest rates change in the short run, especially when they go up rapidly like they have over the last year and a half, it affects both the demand for housing, the traditional channel, but also the supply of housing. People are like, well, I don't want to sell my house. If I got a 3.5% mortgage, if I buy a new house, I'm going to have a 7.5% mortgage. So it can gum up the works a little bit. I don't feel like that's a permanent effect. I mean, in a way, like with all the housing, in inflation, it just takes some time to work its way through. And
But do we ever get down to a 3.5% mortgage again? Does the Fed get down, interest rates low enough that we see the market rates come down as well that far?
Whoa, now you're in this is a deep.
I'm definitely trying not to use the word R-star.
You don't want to use the word R-star, but that's kind of the question of, if you come back 5 years from now, will we be back in this environment where the Fed's trying to figure out what to do and the interest rate is 0%? I don't think anybody really knows. I think there are a lot of people who have opinions about, will we go back to what things were in the mid-2000s where rates were at 0, or will we go back to more historical norms? Some of that has to do with demographics. We're getting a little too big for our britches, in the central bank world as we contemplate that. In the here and now, I think let's watch the immediate inflation numbers, the new numbers that are coming in, to whether we convince ourselves that we can stay on this path where we could get inflation down on approaching target without having a big recession. That will be a triumph. I cannot emphasize enough. That's virtually unprecedented. That would absolutely be a triumph, and that's where we should put our eye right now.
Well, the long and variable lags theory would suggest we're still going to see restraint hit the economy, and we could see a real drop in growth. And some of the soft data that we're getting, the sentiment data, suggests that maybe that's coming. Do you think that's a danger at this point, or can we put the hard landing to bed?
It's definitely a concern, and I don't see how you can look at the historical record and not think hard landing should be a concern. It's virtually unprecedented to get inflation down a lot without generating a hard landing and a tough recession. That said, for the last down a lot without generating a hard landing and